So here I am, 10,000 trades later. I never set out to trade 10,000 times. I set out to have a repeatable process, because an idea without a process is like a ship without a sail. I can almost count on, like clockwork, that I'm going to do 12 to 15% per year. And then the real question, do I get 16, 18, is sort of upside of what's happening with the growth aspect of the stocks.
Over 4 training sessions, options trader Paul Gundersen walked through every step of the wheel, from selling your first cash secured put to managing assignments and selling covered calls. We've condensed that training into this masterclass so that you can learn the complete strategy in one place. Let's get started.
Hey, ChatGPT, tell me about dividends across the Dow, NASDAQ, and S&P 500. There are 515 companies in this market basket of stocks. What is the average dividend yield among these companies? Comes back, 1.2% average dividend in these stocks. Translated, that means you need $1 million to generate $12,000 a year. That is sobering. Living off dividends alone might be a hard life for you. And so what if you could generate that same $12,000 with $100,000 in capital, a 10x reduction in capital? Enter the wheel strategy. Making money through growth, income, and what I call rent. And we're going to explore this today. When we think about growth, we think about stock appreciation. When we think about income, it's dividend income in this context. And when we think about rent, this is monies collected trading through the wheel, also known as option premiums. And so this is the context, this is the way I think about it, and I want you to have a chance to hear the story at a much more detailed level. Now, let's get started. In terms of the vision that I shared with John at the beginning, is to help people of all ages to increase their income and move towards financial independence. And so the vision I have is to help people of all ages, learning objectives, to consolidate everything I've learned and provide you with everything you need except for money to get started, and to help you understand the realities of the strategy from the first minute. And I'll say this idea about sharing the love. 2015, a friend of mine named Dale Perryman, who runs a trading group called Trade Diff, they trade options, longtime friend of mine, he called me and said he had just learned maybe a couple of years earlier about options, and said, Paul, you need to learn about this. It's a game changer. And I was busy with my career and my portfolio was doing fine. And my actions blew him off. But he kept poking me in the ribs and saying, you need to learn about this. And so finally we scheduled some time. We met at some city, had a bunch of whiteboards and chart pads, and worked through. And it was like one of those stereogram pictures, the ones that look like this, and you move them back and forth in front of your eyes, and then finally the picture comes into focus. That's what happened with me in options. And all of a sudden the lights went on, and I thought, this is a deal. So 2017, I started trading the wheel. I got kind of busy 2018 through 2020, pandemic hit us, stopped. But sometime in there, I reflected and I remembered that 2017 was a particularly good year in my portfolio. And when I did the analytics on it, I came back and realized that option premium was the biggest part of the pie that year. When I looked at growth and dividends and rent, that it was a big deal. So here I am, 10,000 trades later. I never set out to trade 10,000 times. I set out to have a repeatable process, because an idea without a process is like a ship without a sail. And so my purpose was to repeatedly make incremental profits. And I guess over 5.5 years, 10,000 trades equates to maybe 5 or 6 trades a day. I do trade this strategy all the time. I'm in the market every day, okay? Now, you don't have to be, but you could be if you wanted to. Now, my question for you is, what is your number? And maybe your financial advisor is saying to you, you need X to retire and be financially independent. And you're saying to yourself, oh, well, I have Y. I have Y dollars. What can I do? So herein is why I bring the wheel to you as a possibility for generating income. In this course, we'll cover all of these different topics and drill into them from basics to advanced topics to gotchas. And I've got real world examples. We'll talk about trade execution. Today, we'll put on a trade or two that is real, and we'll track it throughout the course of this. I'm going to use real money, and I want you to see how it works. Now, conceptually, the wheel is like real estate. You can rent out your stocks like property. And let's drill into this because this is a central tenet of this course. And everyone seems to know something about real estate. So let's relate that to the options world. In real estate, the property is the parcel, the unit, the condo, right? My mouse is not moving ahead. My screen is not moving. Ah, what just happened? I just lost my PowerPoint. 1 second here. Bring this back up. I've never seen PowerPoint die. That's a new one. 1 second. All right. In real estate, the idea is the property is the parcel, the unit, the condo, right? The contract, you may have signed a rental agreement at some point in your life. Rent, the contract obligates you to a certain amount of rent per month. And there's a term, the contract is active for a period. And there are all kinds of ways to sort of renegotiate contracts. You can buy out a tenant. If I'm the owner of the condo, I can buy out the tenant. I can extend the lease. I can buy out the tenant and get a new one, right? And so let's relate this to the options world. In the options world, the property is the stock. The contract is we buy and sell option contracts. The property acts as collateral, if you will, whether it's your cash in your account or whether it's the stock itself. Rent, premium is collected. And that's the term. Lock in on some of these terms. If you're not familiar with them, I'm going to give you a term sheet in just a minute. Term, the contract is active for a period of time until expiration. That's the options term for when the contract runs out. And then renegotiating, well, we can close a contract and get out of it. If we're into something and we need to get out, we want to free up cash, or we don't like the position anymore, we can close it out. We can move an expiration date out further in time, which is like extending the lease. And you can roll, that's an options term for closing out a current contract and entering a new one, just like buying out a tenant that I don't like, getting rid of them and paying them to get out, and then selling a new contract. It's called a roll, and you net the difference. It's the spread between the two. So these are terms that I like because as I started sort of contemplating the option market and covered calls and cash secured puts, these corollaries, these parallels were very, very helpful to me. Now, let me put my money where my mouth is and talk a little bit about my journey and stats, okay? This is my portfolio over 5.5 years, and I'm going to call attention to a couple things that you'll want to know, okay? Now, I've obviously removed the numbers, but my purpose in this is to help you see the trend, and that to make a case that you can make incremental profits in your life by trading the options as well. So what we see here is 2021 January all the way to Friday of last week, my trend. And I'm going to describe what is this up move and what is this down move. But if you eliminate these two things, this line is basically a straight line. Incrementally, every single month, I'm making money. Most weeks, I'd say, on a 52-week rolling average, I'll win 48, 49 weeks, most of the time. So I'm incrementally bringing in profits, and a win is defined as I made money that weekend. All right. Now, secondly, down here, note that when we talk about where did the income come from in my portfolio, that rent, option premium, represents a very large part of this bar and of this trend right here. Dividends, which are next, are probably what? This is a third the size of this overall pie right here. So you can see that I'm, even in this graph, I'm 3.5 to 1 option premium rent to dividend ratio. So you'll see this pattern in your own numbers when you create a repeatable process and you start doing this. You will see it, and it will take time and it will take patience. Now, as to what is this and what is this right here, okay? Notice it is 2022. And in 2022, let's kind of dial back to what was actually going on in 2022. In 2022, the market took a slight nosedive. This is the Standard & Poor's Index. It dropped 26% is from the peak to the trough in 2022. And then we started to see this very nice uptick from here to here, okay? Now, in my trades, what ended up happening then is that I made a bunch of money. See the difference between this 2021 and here? I made a bunch of money in here, and I ended up rolling lots of options way out in time, and that translated mean I got a lot of money, of a windfall, meaning all of this in 2022. But at some point, I came back in 2023 and early 2024, these two down bars, and I allocated my portfolio. I sort of rethought what was I wanting to do. And the main goal of selling all this and basically giving a lot of this back right here in this down move, my main goal was to reposition my portfolio now that I'm retired so that I would generate consistent income thereafter, which has been real. Okay, so that's a bit of my story in terms of my trading. But once again, the option rent component to dividends is typically 3 to 1. It used to be in my portfolio even higher than that, but I have ended up finding that I make more money in option premium by far than in dividends. And so as I've shifted away, I still have dividend stocks, of course, but as I've shifted and made that less of a focus when I choose a stock, then that ratio is obviously going to change. But if I showed you the same chart 2 years ago, 3 years ago, it would for sure be 4 to 5 times options to dividends. Now let me move on from here and give you another picture. It sometimes is not good to do business with family. This woman in the middle, her name is Grace. She's my 86-year-old mother, and she moved into independent living during the pandemic, or right before it anyway. And her facility and just prices in general, everything went way up. And she needed to generate more income off of her money. So I said, well, here's the value proposition, Mom. You're going to get 1.2% dividend on your income in S&P Dow and NASDAQ stocks. I think I could really reduce the amount of capital you need to generate the same amount of money like we talked about at the beginning. And here are her numbers in a smaller portfolio, but the patterns are exactly the same, okay? We see movement in her numbers, a quick uptick, right? Some right away. This is 2 months of 2022, full year, half year. And I think I'll move this we'll double this money by the end of this bar by the end of the year, but fairly consistent, little flat spot in terms of her trend. And we hit a flat spot in 2025, but we're now kind of moving up again. Her option to dividend ratio is fairly high. She's like 3.5, 4 to 1. And you see that reflected here in the pie chart as well. This is the dividend component, and this is the option premium component. Real numbers, and you see year by year, how we generated. This transition cost that you see here, it's a tiny thing, but along the way, 3M acquired a company, and then they got into a lawsuit and they got rid of them, and a company called Illumina did the same. They acquired a company and then they had to divest them. And so by the time they split off the shares, we had some transition costs, but overall, she has done quite well. So I share these with you to say in very real terms, you can make money in options. Now let's get into away from me and away from real estate and
Paul, very quick, because there is a question here about why did your income reduced in 2024, 2025, 2026? It's being asked.
Oh, in here, in these areas? Yeah, that's a good one. Well, I was wiser about my picks. In these first 2 years, I generated an awful lot of income at the beginning of my wheeling, because once I would get into what's called the cash secured put part of it, the covered call, and I owned the stock, many times I would push the option way out in time and generate lots of money. But what that meant is that in future periods, I was waiting for those options to expire, and so it went down. And I also think I did a reallocation when I retired in early 2024. I moved a bunch of money into 2 mutual funds called JEPI and JEPQ, and the purpose of that was so that every single month I knew that I was going to get a very the amount of money I needed to cover my expenses. So my portfolio size is a little bit smaller in these areas.
We're not going to be very long on these questions, but there are 2 very quick. You can answer very quickly. Why was 2025 so flat for your mom? And there's also the question about what has been your annual percentage return on average. Yeah. And then we'll wait for what other questions there are.
Yeah, good question. So 2025 was a tough year for my mom in terms of, I wouldn't say tough, but we made a lot less than the prior 2. And that had to do with rolling a couple of options out in time quite a lot that inhibited my ability to trade in 2025. The challenge in her account was that the money we were bringing in, we were paying out. So there wasn't a lot of liquidity. Like, I didn't have a lot of cash in her account. So sometimes when I needed to make an adjustment, my only way to make the adjustment was to push the option further out in time. And then therefore the income I had was reduced until these contracts expired. Second question, if you come back to that. Oh, annual returns. I'm generally doing, I guess last year I did 16% on my portfolio. Year before that I did 18, almost 20. And so I'm very routinely getting, in the, I can almost count on like clockwork that I'm going to do 12 to 15% per year. And then the real question, do I get 16, 18 is sort of upside of what's happening with the growth aspect of the stocks. Now, notice that this chart and the other one like it only describe the idea of income. I'm not adding growth to this as well. So this doesn't reflect growth. It only reflects income through dividends and rent. Okay, let me keep us going because we've got a lot to cover. All right, in terms of terminology, I want to get you thinking about the terminology of options. I wish someone had put together for me a one-pager like this that said, these are the terms you need to know about and get into your bones right away when you are selling options. Okay, so I'm going to hand this out. I want everyone, as part of your homework, to get to know these terms over this session and the next couple, but they're absolutely critical that you get these terms in your bones and know what they mean. All right, so be aware of these terms. They're very important. I'll highlight the ones that matter as we go. There are 4 ways to trade options, and this refers to generally trading options as well as within the wheel. So I offer this to you just to be aware of, and this actually came from a mouse pad that my son gave me for Christmas, and I thought, wow, this is great. I am a net seller of options. If you do the wheel, you are a net seller of options. And the short story of that, let's take one of these ideas out for a ride, okay? When you sell a put option, you do not own in the wheel, you do not own the stock yet. So note my points here at the very top. You don't own the stock, and you want to buy 100 shares of ABC company that is at $100 a share. And you say, hey, I'd be willing to buy it at 95 or less. So you sell the 18 June ABC 95 put. That's the nomenclature of options right there. And you collect $50. Okay, that money comes to you as soon as you sell that option. It goes into your account. It's yours forever. You never have to give it back. When you put the trade on, you have you said I'd be willing to buy it at 95, and you want an option contract covers 100 shares. So it means $9,500 is being collateralized until such time as the contract is settled at the end, when it expires. Now, just by contrast, I want you to know this. This is Berkshire Hathaway Class A shares selling at $747,000 per share, which means that if you wanted to sell the same covered call on 100 shares of this stock, you would need something like $74 million in collateral. Okay, so fortunately, the shares that we're trading are much less than that, but it's an important thing to consider. And then on the selling side, then over here, now you own the stock. I bought it at 95. It's at 100 today. I want to sell 100 shares. I'd be willing to sell it at 105. So now you enter into, let's say, the 26th June expiration for ABC 105 call, and you collect $50. Maybe you collect $100, depending. There are a lot of variables that determine option pricing. But all that said, that's how it works. The collateral in this case on the trade is the stock. So you need the stock in your account. Depends on, I'm assuming you're going to be doing this in an IRA, a tax deferred or tax-free Roth account. If you're doing it in a taxable account, then you may have margin rules that can apply as well. So that's a whole different story. But these two concepts are central to how we sell options. If you're on the buy side at the bottom, then that's another thing. The other terms I wish someone had really educated me on, it took me a while to sort of get it, is that when we hear the word short, that's always associated with selling an option. When we hear the term long, it's always associated with buying an option. And just think short, sell, SS, and you will forever lock in on that. All contracts in any of these four boxes, they all expire in the money or out of the money. It's another term you'll need to know, all right? Rules of engagement, let me just take us down through this, and we will soon be, there are a couple things you need to know about. Rules of engagement, your accounts. You know, there's a process with your broker for enabling option trading within your account. Enabling your accounts can take between a day and a few weeks. And I had a guy call me, and we spoke about this. And when he went to fill out the survey that they asked him, he answered questions slightly differently on different occasions. So now he was quizzed by a representative from the broker to determine if they're willing to let you trade options. So there are different levels of trading, so you need to be aware of that in your accounts. I mentioned this briefly, that taxable, tax-deferred, tax-free accounts, if you're using margin in a taxable account, check with your broker on margin rules. Margin is not allowed in tax-free, tax-deferred, traditional IRA, or tax-free Roth accounts, just not allowed. And then technically, rules of engagement, a stock must be optionable. If it's not optionable, you can't sell options on it. One standard contract controls 100 shares, so you're always thinking in lots of 100, and you must own or be able to purchase 100 shares of the stock. So for instance, Berkshire Hathaway, I couldn't possibly purchase $74 million worth, but ServiceNow, which we're going to buy today, I can. So you need to be able to do that. And then practically, there must be enough liquidity in the stock itself to trade the options. It's a gating item for me in choosing a stock. Liquidity comes down to two factors, in my opinion, maybe three. But let me put it in, I'll add a third. That liquidity comes down to what is the volume on the stock itself, right? And secondly, the size of the option chain. Let me see if I can give you an example of this, all right? This is in Charles Schwab's Thinkorswim. And I want you to see just right here that if we look at the volumes on the Magnificent Seven, right? that's a lot of volume on these stocks. If we go down into the S&P 500, you can see those same stocks at the top, but notice, it really tapers off here in terms of the volume on the stock. And as this volume goes down, your ability to trade options also goes down because the size of the option chain becomes a lot smaller. So we're going to talk about that, and I want to show you some of the tools that I use in various sessions we have about how I determine that. But the size of the option chain is a big deal in terms of the number of contracts. And then what I call the bid-ask ratio. If there's a wide spread, then your ability to trade an option is diminished. So let me put that in its proper context. So you're selling something for $100, and you're sitting on one side of the table, and I come to the other side of the table as a buyer, and I say, I'll give you 70. So the bid-ask ratio is 70%. What's your likelihood of getting 100 at that point? And the answer is 0, unless you have another buyer. Now, what's your likelihood of getting 75? Probably high, okay? So as that bid-ask ratio gets higher, so now you're sitting there and you want $100 and someone comes up and says, hey, I'll give you 95. You're probably gonna settle in the middle and you get close to your price. So this bid-ask ratio, known as the spread, is absolutely critical to getting what you want in terms of money, all right? Now, I want to make those points clear in terms of rules of engagement. And then here is the wheel framework where we're moving down. I think we're going to complete all this today to where I'll actually put on a trade at the end. Wheel framework, the steps that keep just turning. And this is where I say you need a repeatable process. These are the terms that relate to the wheel process itself. So what I call the SILTO list, stocks I'd like to own. You'll hear the term the top of the wheel, the bottom of the wheel. You'll hear wheel components, cash secured put, covered call, moneyness, in the money, at the money, out of the money. And then option pricing, premium, again, rent, strike price, and expiration. So this is my view of the wheel. And it's interesting because as I've gone out to Google and done I'm going to just type this in quickly. I want to show this, the wheel strategy, images, right? So this will just give me a kind of a look at different images that you see in Google. But, they all look something like this, or, sell put, sell call, and got something in the middle. None of them mention the idea that is absolutely significant of stocks I'd like to own. So here's how it works, okay? In the wheel, when I develop my stocks I'd like to own list, the first two things I look at are liquidity. Is the stock tradable? Are the options tradable? And second, fundamentals. Now, fundamentals, sector, industry, is there a trend? The stock itself, revenue, is it increasing? EPS, do we see EPS numbers, earnings per share numbers going up? And then can I buy it at a reasonable price? So I look at those things. Once I put something on my list, the very next thing I do, I don't own the stock yet, is I go to the top of the wheel, here's that term, and I don't own the stock, and I sell what is known as a cash secured put. And I'm going to go through that in a little bit more detail. Let me just look at my outline here and make sure I'm going to go through it. Let me describe the cash secured put. So the cash secured put, the idea is, like I showed earlier, that I want to get 100 shares of stock. It's at 100 today. I'd be willing to buy it at 95 or less. So I sell a contract, right? And when that contract is in force between today and like Friday or next week, what happens is, first of all, my $10,000 gets collateralized and it's held off on the side. It comes out of my buying power until such time as this contract either expires or is settled at the end. There are two outcomes, and go back to real estate if you're having a hard time following this. Two outcomes and three choices about what to do. The outcomes are the contract simply expired. On the day of expiration, the stock was at 100. I said I'd buy it at 95. Anytime between now and that expiration, but at expiration, the stock was above 95. So I keep the money, whatever I get, I keep that money if it just simply expires. The other choice is now the stock price goes down. And so the stock gets, quote unquote, assigned to you. It gets put into your account. The money gets taken out. So if you're in this first line, outcome A, then if it was ABC company and you're like, well, I just want to go get more premium on ABC, stay right here and just sell another cash secured put. Otherwise, go back to your SILTA list, pick another stock, and then start at the top and go this way again. If the stock was given to you, then you move to the bottom of the wheel because now we're going to sell a covered call on that stock, okay? And the outcome, and now the idea is I own the stock, okay? I own it at 100. I'd be willing to part with it at 105. So now I sell a contract for maybe 2 weeks, put some money in my pocket, and there are two possible outcomes. A, the stock is above 105. Gets called away, as they say, which means taken out of your account and put into the buyer of this options account. And then you get the money in your account. And then option B is that the contract is what we call out of the money. It just simply expires because the price was below 105. And now you say, hey, I'm going to sell another covered call. And that's how I've made money on this over and over. So this is the full picture about how this all works. Now, where I want to take you between now and the end of our time together is through the option chain, selling a cash secured put, and then actually trading one. So these are the things we have left to do with the time we have allotted, and I'll give you some homework, and then we'll catch up next time. So let me take us through the option chain a bit. Now, these are the terms that matter related to the option chain. And I want to just give you a picture of this is Schwab's Think or Swim, okay? Now, in this, every broker has their own way of displaying this stuff, but in Think or Swim, I'm gonna look at a ticker called ARCC, Ares Capital Corporation. It has 6 different expiration dates between now and January 28th. So it's not very liquid, okay? But it's perfect for this example because the option chain is small. So we're going to drill into June 18th, and then you can see within June 18th, these are all the strike prices for this particular stock. Then across the top, we're looking at puts. So you can see this here. We're looking at puts, all right? And now these are all the key metrics that will get displayed that you need to pay attention to. What's the bid price, the ask price, the mark, which is the midpoint, the number of buyers and sellers, how many people are standing across that double Dutch door from one another wanting to make the trade. Delta, this is an important metric that I use all the time. The likelihood of assignment. How likely is it that when I sell this contract that I'm going to get the shares in my account? Is it high? Is it low? And Theta and Vega, we'll deal with those later, okay? This is the same picture, and this is the more common way that people look at it, where the calls are on the left and the puts are on the right, like you see right here, okay? Now we have all those same metrics listed across the top, and in the middle, they place the expiration dates and the strikes. So this is the traditional layout. Now, there's a term called at the money. The last price sets what I call the line of scrimmage here. So where these colors change from black to blue on both sides, the line of demarcation is the last price, says that, hey, in between 19, the last price is in between 19 and 20. So that's what we're going to call the at the money line. And then you'll see here, I've just made markers for in and out of the money and so on. And these are terms that you need to become familiar with. So let's get on to the cash secured put, because I want to end our time by actually putting a trade on and letting you see how it works. Okay, this is the drill down into the cash secured put. So suppose you have $20,000 in an account, and your choices are, I'm just going to leave it in that account, interest bearing, where you'll get 20 to 30 cents per year. Okay, if you put it in a high yield savings account, maybe you get 3%, which is $600. And if you wheel it, maybe you can generate 2,000 on your 20. Maybe you can generate 3,000 on it if you get 15%. So that's the value proposition. You're taking on a little bit of risk to do it, but it's not insurmountable. You're getting into a stock that you'd like to own. So the cash secured put mindset is, I don't currently own this thing, this stock. Price is at 200. I'd be willing to own it at 194. Actually, these are numbers for NVIDIA last week, okay? And then you say, hey, it'd be great to make some money while I wait for the price to go down to 194 and enter a CSP. I sell an NVIDIA 194 CSP contract that expires on 6/18. This is an actual numbers from last week. Collect $212 in premium. So right away, I put that money, that rent in my pocket, and I keep it. We have to wait around till 6/18 to see what happens. Does the stock go down to 194? Does it stay above it or not, right? And what I want you to just lock on in this discussion is that the cash is the collateral. $194 a share is what you're saying. I'm going to reserve for one contract, 100 shares per contract, $19,000 you have to have in your account to do this cash secured put in a tax-free or tax deferred kind of account. So that's the important part here. Then we move on and we say, well, let's play around with this. I want to see how sensitive you are to some of these concepts, okay? So imagine now that it's expiration day and the price is sitting like right here, okay? The price is somewhere between 194 and 200. Well, what happens? This is called out of the money and nothing happens. I keep the $212 and I move on, okay? I can sell another contract at that time. If this price goes down here, below 194, equal to or below, then those shares get put into your account. It's called assignment. And then the money, the $19,400 gets taken out to pay for them, right? It's a zero-sum game. And but what happens in a cash secured put contract if the price goes all the way down here to like 160? What do? Do you fold, all right, and take overnight a big loss? This has happened to me numerous times. I can tell you, Okta and Workday had great financials, blah, 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 and I got into them, and the next day they plummeted by 20%. So didn't faze me in the least. Now I'm in the bottom of the wheel. I start selling covered calls, and when that stock recovers with all the premium I will have collected, I'll do well. But sometimes that's an issue for people where they go, oh man, it took a beating overnight. And what happens if it goes way up here, right? Then you missed out on the upside. Too bad, right? It can happen. Where you could have essentially bought the stock at 194, and then in a couple of days, it went up to here. You could have bought the stock and made that upside, but you were wheeling instead, and so you had this contract that was in force. And so these are realities of the wheel, okay? And I want you to just be aware of them because they're important. And the other thing is I just added this to say that no one really ever told me this. I learned it just through trading and talking to people. But in American style options, if that price passes your strike before expiration, so let's say it went down to 190 in our case just a moment ago, it went down to 190 before expiration, the buyer of that contract can exercise that contract at any time. Most of the time they don't. Most of the time these contracts are exercised at expiration, but I'd say 2% of the time, maybe 1 to 2% of the time, it's called early assignment has happened, okay? Now we've got about 10 minutes left in our time. I want to walk you through a trade and give you a feeling for like, what does this look like? So we're going to do a top of the wheel trade, okay? And I did some homework already, and I have selected ServiceNow that I want to make a purchase of. Okay, so we're gonna come out here and we're going to take you through an actual live trade. I know this is a lot of information all at once, but this is the real deal. Okay, so in Thinkorswim, we go to our trades tab. I've already got ServiceNow listed here. Let's go into the trade grid and let's go into the option chain and get a look at this. So I'm going to sell a cash secured put on top of the wheel just to sort of bring everybody back to the visual and where we are in it. Just a minute. Let me just show you that, because I think context is really important right now. Okay. All right. So we are right here. Okay. I've said I want to buy ServiceNow and I'm ready to sell my cash secured put. That is what we're about to do. Right. Get this out of the way. And here we are. Right. Here's all the pricing. I'm on the put side of this equation. And what I'm doing is I'm looking and I'm going to choose this one right here. Okay. This is an out of the money put, meaning it's below this at the money line right here. And maybe this will give me $75. Let me decode this for you for just a minute. Is when I choose this, there we go, that you can see that in my choice, the bid and the ask, I'm asking 80, someone's offering 70, the midpoint is 75 cents. The delta is 23, which means there's a 23% likelihood that I may get this stock. It may go down to 98 by Thursday, which expires. Okay, so I like it. That's the trade I want to make, and I'm going to now adjust my number of contracts, verify that I'm doing what I want. This is the 18 June 98, and I'm 18 June 98. And I'm going to sell this, and I'm going to put it in at 75 cents, okay? And then I'm just going to confirm and send, right? And it's sold. Yay, okay? So I ended up getting Dell. I ended up doing the wrong trade right there. Let me reverse this trade. I did the opposite order. I'm going to delete that and see if it'll go through. I'll tell you what, I'll take care of this after. Haven't done that before. Oh, I'm in Dell. I need to be in now. There we go. Sorry about that. All right, let's start this over again. So I want to find this one, the 98 right there, okay? Just need to get this to where I can see the proper information, all right? 98, 23 delta, ServiceNow, sell it, okay? And I'm going to adjust my number of contracts down to 1, which is what I'm after. Confirm and send. Now because I have this Dell thing, I'm stuck. I need to unwind this Dell. Let me take care of this. This thing's bogging me up. One more time. I'm going to do this again, create a duplicate order now, and just submit it, all right? And that should do it for me. This is ServiceNow. All right, so I've just wiped myself out. Let me see if I can take care of this, because I want to wrap it up and have this all logged and everything so you can see what is going on. But I need to quickly get a feeling for filled orders now. All right, this looks like this is in motion, actually. Filled orders, yeah, it's in here. It's in the account. We did it. The last thing I want to do then is, before we sign off, and again, before I give you some homework, is here's a tracker I've developed that I'm going to give to all of you to be able to use, okay? So what we just did is we sold in my Roth account today, sell to open, STO, it's one of your terms, ServiceNow, cash secured put, 18th of June, which is Thursday. The strike price of that option was 98, and we got 75 cents, okay? 98 is the strike, and we got 75 cents, which actually means that I got $75 in my account just now to do this. And now we wait until Thursday. And this gives me a real-time update of the actual trade that we put on. And we'll come back to this now at the beginning of the next session. We'll say, well, how are we doing? Like, well, what are my choices, right? If I got out of this trade right now in real time, I got wheeler's remorse and I didn't want to do this, I could exit this trade. I got $75 on the inbound side. I could sell the contract and get out of it for 70 and net 5, okay? So these numbers are updating in real time. When we come back on Thursday, we'll start right here, okay? Now, let me take us back to your activity of what comes next for you, okay? For you, I'm going to put up on through the John's documents, we're going to give you the list of all the terms, and we're going to give you the meaning of all the terms that we have right here, okay? Again, I wish someone had done this for me a long time ago. Second, you have some homework, and do it, because you'll make this your own by doing this homework, and it will improve your life. And let me say this, if you put 15 minutes a day into this instead of scrolling through YouTube or watching TV for a year, that's more than 100 hours. Do you think you could master this in a period of time? Absolutely, okay? Now, so your assignment is get familiar with this terminology that I've listed right here, because it's so important, and then pick a stock that you would like to wheel and be ready to tell us the next time that we meet, okay? And I'm trying to think if there are any other things I'd like to give to you before we go, but let me just review a little bit about what we covered today, okay? 1 second. Today we covered first the idea of, hey, ChatGPT, tell us about dividends. And we recognized that an average dividend on the Dow, S&P, NASDAQ of those 515 companies, 1.2%. We talked through the real estate idea and the analogy that we have between option trading and real estate, which is very strong. I walked you through my journey and my mother's journey in terms of stats. And the one thing I'll say on that is, hey, when I went to my mother, I was like, should I really do this? Am I backing myself into a corner? Am I going to create a problem in our relationship? And fortunately, no. Unfortunately, we've met all of our objectives. But we did say going into that, and my brother, who is a big-time trader, said, hey, look, you need to put a scorecard in place. And if it ever turns yellow or if it ever turns red, know what your actions are going to be. And we did that. We went through terminology, and I encourage you to look at the terminology sheet and start getting it into your bones. Rules of engagement, there were 4 different areas. I gave you an overview of the wheel framework, a drill into the option chain, which to me is the place for most people, spoiler alert, where they just say, hey, that's too complicated. I don't have enough time. And my thought to anyone who's got those thoughts running through your head right now is give this time. Give it, because the outcomes are what you're after. You want repeatable trades where you can make the money and have the kind of graphs like I'm having, and you can do it. And then we did a cash secured put, our first trade, defined what that meant, and then we did our first trade today. So that's a lot of ground to cover in one day. So I encourage you to, let me just bring up the homework slide one more time, but let me just bring this up and ask you to screenshot this, if you will, and then we'll wrap up. Now, let's return to where we started the other day. Let's trace through quickly what we did with ServiceNow the last time. As ServiceNow was trading about $100, we said we're going into the top of the wheel, and we said I'd be willing to own it at 98. We placed a trade. We thought, oh, can I make some money while it waits to hit 98? And so or 190, I've got my numbers wrong here. We sold, this is 98 down here, sorry, and this is 100. I've got these numbers backwards. But nonetheless, we sold a June 18, 98 put contract on ServiceNow. We collected $75 in premium. And what that means is that when you sell this contract, that you have $98 a share times one contract times 100 shares, for a total of $9,800, which is the collateral. It's the cash that gets pulled out of your buying power in your account, okay? Now, and then the whole other point that we need to be mindful of in this is that when we are, I put my screens around, I'm a little bit discombobulated here. 1 sec, 92. All right. Is that what we expect to happen here is that if this price closes at 98, a little bit higher, somewhere in the range up here, if it goes higher, then that's considered out of the money at expiration or any time in between. And if it goes lower, then that stock is going to be assigned to us. So let's see what has happened in our tracker, because this is where it all comes together for me. It's when I look at this type of thing. And in our tracker now, right here, note that this is flagging us as in the money. So let's look at our trade and exactly what we did. Okay, so on the 16th, we sold to open. This comes right out of your terminology sheet. So get to know that terminology of it. When we sold to open, the now CSP, 18 June, strike price 98, we received 75 bucks for it. One contract, 9,800 shares, and off we go. And today, this is trading at $4. These are actually real-time numbers using those RTD functions that we just spoke about. So you can see that our option price and our share price are changing as we go. And we have an in-the-money option right now. And the point I wanted to make about this in particular is just to say that the cost basis we have is $75. Right now, if we chose to close this, it would cost us $320. And on the position, we would be underwater $245. So now what I'm going to let happen on this stock, on this CSP, I'm going to let it assign over the weekend because it's in the money right now, and the clearinghouse will take care of all the housekeeping. And on Monday morning, I will have 100 shares of this account, of this stock in my account. When we come back on Tuesday, we're going to sell a covered call against it. And I'll just say one other thing before we move on, that the fact that it would cost me $250 to get out of, there's no reason for me to do that. My premise on ServiceNow is that it's a great company for a long-term play. I did my homework with my Silto list, and the fact that the stock is trading at 94 versus my strike at 98, this is very commonplace in selling CSPs at the top of the wheel. All right, are there any questions on this before I move us along?
I don't see any question on that, but we do have a lot of responses on which tickers people would like to.
All right. Well, I will definitely get to that. So hang with me, and I'll call it out in a few minutes. Okay. Now, the only other point I want to make is that we coming back to this diagram that we looked at the other day to say that when you sell a put option, if it ends up in the money, you are obligated to buy it at a certain price, which is the strike. So I like this chart because it makes it really simple in terms of the decision tree and helps people to understand where they are in the process. Okay, now let me move us on to the next piece. Is I have a covered call to sell that I want to move us through, because I had previously purchased 100 shares of Microsoft stock, and they're sitting there not making any money. And so let's go through the process of setting up a covered call on Microsoft right now, so you can see how that part of it works. Now, I have an Excel tracker again that I've created, same tracker, and now we'll look at my second trade, okay? Now, in this case, I had, let's go through the terminology again. I had placed this in my P-Trade account on the 16th. The terminology of the order action is buy to open Microsoft stock, and my entry price was $386, 100 shares. You can see right now it's trading at $377. So as I go across here, it's trading at an $874 loss right now. Again, I have to say my philosophy on it's an unrealized loss right now. doesn't bother me in the least at all. If this went down 20%, I would not blink. Why? Because I, like Warren Buffett, believe the idea that if the stock's fundamentals are good and continue to be good, and we continue to have a bullish premise on this stock, I'd buy more of it if it went down 20%. And I'm willing to hold it for a long time. My criteria for adding it to the SILTO list is saying, I believe in it, and I'm not going to let, if it goes down, I'm not going to let that crush me. Now, if my premise changes at some point in time because of some nuclear explosion at Microsoft that ruins the business, well, that's a different story entirely. Then I'd get out of it. But so where we are right now is we need to add a trade. So here's what I would do in this tracker. And I'd encourage everyone. The reason I built this tracker is because when you start having multiple trades, and you really have to know exactly where you are. In next session, we're going to talk through the idea of rolling stocks or rolling options. And then there's always this question I get is, well, if my purchase price is here, should I roll below my purchase, or should I just keep my strikes above it? And so we're going to drill into that, but nonetheless, so my point is I built this tracker so everyone has a starting point that if you're going to use this, please start here. Call me. I'll even help you add lines to it if you have more trades. All right, on we go. 6:18, we are going to sell to open the Microsoft, and this is going to be a cash covered call at this point. Now, we've got to go choose the expiration and the strike. So now let's come over to Thinkorswim and go do that. All right, in Thinkorswim, I'm going to do this properly this time and go to Microsoft. And now in terms of choosing the strike date, let me just look at the calendar here. So we meet again on Tuesday. I want this, I'm going to sell it now, and I want it to expire on Monday so that we can review it Tuesday when we get here. So we'll go to the June 22nd strike, okay? And this is on the call side, so we're over here. And now the way I think of it this way is I like 20 delta. It is my magic number for where I like to place my strikes. So here's the 20 delta, the 15 delta. I like selling in here. And you'll see why when I show you my trade transactions later. So I can imagine I'm going to get, this is called mark. It's the midpoint between the bid and the ask, which is sitting here at 22 delta at about 116 per share. So let's go ahead and trade it now. So what I have to do is I have to click and just do sell, adjust this to one contract so that I'm taking up $38,500 in my, this is covering my stock now. And everything looks good. So let's confirm and send this trade. It's going into the proper account, and we send it. And it executes. Perfect. Okay. Now it executes, and it executed at $1.14, right? And don't worry about that other one. That's one I cleared out this morning to take care of some housekeeping. So this is now the 6/22, 385 strike. And now you start to see that my numbers start updating right away. Okay. This premium per share is forever changing throughout the day. My trade is noted here as out of the money. And I think we're kind of good to go in terms of, I don't have anything else to do, but on this stock, I have just taken in $1.20 in premium. So one of these numbers, my premium collected, this should be 117 right here, okay? So I've collected 117 in rent, and then you can see that this is the cost to exit, and this is 117 as well. So this tells me right here, my P&L on this stock, on the transaction, is right now minus 747. So, and what'll happen is over time, if this continues to be an out of the money call, then that 131 will go to zero, and I will, and as 131 goes to 0, then 46 goes to 177. All right, so that's the Microsoft trade that I already had Microsoft. And just to confirm a little bit about what just happened here when we go back to our process, I'm going to take us over here. So we were at some point, there are two ways to get to this number, right? To get to step 3, okay? And what I had previously done is I had previously purchased this stock outside of the wheel. So I'm coming in from the outside, meaning I previously purchased it. And I'm like, oh, you know what? I have 100 shares without any calls on it. I might as well start monetizing that. So that is exactly what I've done here. Okay. Questions on this before we move any further? All right.
Just a minute. There's only one question. I think you touched on it though. From Ivairo, would you ever just keep rolling the put for credit? What is more profitable, rolling the put or sell a call?
I am going to show you transactions today that demonstrate clearly that I will roll and roll and roll and take and stay in the bottom of the wheel. I will do this often, and you're going to see trades that when I choose them from my Silto list, if my premise remains the same, that the stock is neutral or it is increasing and it continues to meet my objectives, I will continue to do this green circle right here and just continue to sell covered calls. And there's a lot of money to be made there. I'm going to show you one exception today of where I've been in the top of the wheel. I can't get back to that slide easily now, but where I'm at the top of the wheel, and I've been in that since January, and I've made a small fortune. Okay, but that's unusual. Most of the time, I'm going to get assigned. It's without a doubt. I'm going to move right now into the idea of the progression we'll go through. Is I'll share with the idea of how do I develop my stocks I'd like to own list, and then I want to show you 2 methods. One that I used for the first 4.5 years of my trading, and a second that I started using recently that has been very, very helpful and accelerates my whole decision-making process. So I want to show you that. And then at the third part of this discussion on Silto is that at the end of it, let's then take on these tickers that you sent in and get a look at some of them. That's where I'd like to go. And John, at the end of that.
Okay. So I will open the first poll now then.
Yeah, open the first poll, and then I'll move the second poll, later in time. Building our Silto list. This is the high-level process. We're at step 1. I had said previously that I look at liquidity and I look at fundamentals, and I do it in that order. Why? Because it's the most efficient way to quickly narrow down the universe to the money you have on hand to trade and the stocks that meet your criteria. Okay, so think of it this way. I'm going to go through an example today where imagine I have $15,000 in my account. So I only want to review stocks that are $150 or less because I can't go any higher since I have to purchase 100 shares at $150 max, which is 15 grand. Okay, so just be aware of that. So I'm going to show you what I've done, and let me just see if there are any other slides we need to go through here. No. Okay. All right. Silto liquidity. So what we want are options that are tradable. Start with the largest stocks. I'm going to show you what I do in Thinkorswim. Scan highly active, review expirations for breadth, and look for narrow bid-ask spreads. And what this will lead to over time is you will have easier entries and exits without having to adjust your prices much. You will have easier rolling opportunities, and you will have higher profitability. If you go with, so trust me on this, I can tell you from 10,000 trades that it has really made it clear. So In TOS, you can set up watch lists, and we're going to go through a handful of these to give you a feeling for it. I'm going to do it in PowerPoint first, and then I'll jump over to the live system. But I want you to see this, is that I created a series of watch lists, which anyone can do at any platform. Then I drill into it. I've organized the metrics here of volume, last price, and change. And I filtered this by last, so that I'm sort of knowing that I'm below my $150 threshold. Now, I just took this one as a starting point, Universal Health Services Class B. It has very limited option chain, very few expirations. Move on, run away. Why? Because it's not tradable. And I'll show you an example of one I'm doing right now that it'll be really clear for you. This one, Prologis, I'm just picking them at random. It has more expirations, great. Look at this one. The first introduction of weeklies. You want to do weekly, you want to think about weekly options. I would say when you trade and do the wheel, that there are really two broad choices that you can choose depending upon the amount of time that you can commit. If you can commit like once a week, I can do a sit down and I can do it like clockwork and never miss, then trade weekly options. If you can only sit down once a month, then trade the monthlies, and that will be your cadence. It's an important way to manage these kinds of trades, and for people with different degrees of time, you can still make money in both models, but I definitely find the weekly helps me more. It's like what I mentioned the other day, that turns of tables, if for servers at restaurants, they know if they can turn those tables, you're gonna get more tips. And it's the same thing here, because if I have a weekly and I can roll weekly, I have 52 opportunities to make money. If it's a monthly, I have 12. It's just that simple. So be aware of that, okay? So I look at these, every now and again, you're gonna come across something in an option chain that looks like this. And my question, when I know what it is, when I look at it, is there has either been an acquisition or a divestiture, and essentially those yellow items that you see here are not tradable at all. So I'd avoid those like the plague. More weeklies. This is ExxonMobil. It has a much deeper option chain. You can do scans as well. Now let me show you in the live system what this looks like. So here we are in Think or Swim, okay? And I've got to turn on my sidebar here and then come over to the Trades tab. And I'll just go through the same idea, because now I want to drill into these a little bit more and give you a better feeling. So once again, these are sorted from high to low. And where is the one I'm looking for? It's up here around 146. Let's start here. This is like that first one we showed. There are only 5 expirations. Look inside of here, okay? What do you see? And I can explore this anywhere, but I prefer, let's just go to the at the money line. And look, there are no bids at all. So there's a really wide bid to ask ratio. Walk away. And you'll see this quite a lot. I just went into the first expiration, but I'm going to see the same patterns over and over in these others. And I happen to know, I'm looking at the volume, it's only 629,000 shares, walk away. But if I go down to something like, we did ExxonMobil, I think somewhere in here I found Palantir. Oh yeah, 25 million shares, lots of choices. We go into the June 26th, which is next Friday. And notice here, a tight bid to ask spread in terms of 335 versus 325. You'll probably get 330 for the trade. You're getting more premium for this guy because there's volatility involved. So Palantir would be on my stocks I'd like to own list in the range of less than $15,000 capital requirement because it fits, okay? Now, let me contrast this with Walmart, okay? Walmart, another big behemoth, and it's trading in about the same range. What is WMT, I think? Yeah, okay. So WMT, and this is trading at 117. So I need $11,700 to get into this. But look, I'm only getting $1 and maybe 40 cents, $1.38 when I trade it, and it tapers off from there quite quickly. It's 3 times less than Palantir. But It has a small dividend. It's paltry, but it has a small dividend, and it is less risky than Palantir. So you have to choose what volatility level you're interested in when you go to trade these stocks. So Palantir was at 54.6 in terms of volatility. And if we went in here, and I think if I scroll down to the bottom or top bottom, maybe I'd be lucky to find Walmart. It has a volatility of 27. And so that's definitely going to be reflected in the stock price. But the short list is on any of these, you can write scans that make this whole process easier. So for instance, I wrote a scan here, and this is everything on the Dow, S&P, and NASDAQ that is less than $150 a share. And it gives me a great place to start. And when I used to develop my Silto list, this is the way that I did it. I would just very quickly scan. And I want to say there's a big objection that many people have to this strategy as they get started, because they say, holy cow, like, this is going to take a lot of time. Like, I don't have the time to do this, right? And so, what do? Right? So it's an objection that I hear people speak of, where they say, I just don't have the time to do this. It'll eat up my whole week, and it can, right? But you have to choose your level of involvement. Is weekly appropriate for you? Is monthly appropriate for you? There's a startup cost to anything new in life that I find that many people spend more time in front of the TV every night than they do thinking about their financial future. And so think about what your trade-offs are, but it's an important factor. I think there is some time to get involved, to get up to speed. But after a period of time, I start having a pretty good idea about these stocks. I start having lists, and I forgot to tell you that I also keep a OneNote on any single stock that I get into. I'm doing this on the fly. I have not looked at this in a while. Let's see. Stocks I like. No, maybe I may not find it. Let's see. Let me find NVIDIA. It'll be in here. All right. So on every stock that I keep, if I can find my list here. I can't find it. I'll bring this up next time. It's actually a good book to get a look at, but I can't seem to find my way around it right now. I'll show you my OneNote, but on every single stock, I keep track. Oh, here it is. All right, here we go. On every single stock, I keep a OneNote. So on anything I've gotten into, I will keep a list, and it starts with why own this stock, about the stock, metrics of the stock, and I'm literally cutting and pasting into here what I'm seeing as I'm looking over the stock itself. So I just created a template, and for pretty much any stock that I've gotten into, I should have a one-pager or some level of detail of what did I look at the time. Now, I didn't always do this, but it became important to me when I started having some positions that I held for a long period of time that I just really couldn't remember later on, years later, why in the world did I get into it in the first place? So I keep a OneNote. I suggest you do something so that you have a trade log of why did you get into things, okay? Now, let me show you. So the first part of this was to say the think or swim way, which you see in this picture right here, okay? And the second way is some technology that I've developed for myself that has become very, very useful in terms of streamlining my process. And so, let me just get my screens organized. So that looks like this. What we're looking at here is there is a stock called ARCC, and it is the reason I'm going to show it to you. Let me show you what it looks like in Think or Swim so that you have a similar idea. We're going to look at just the calls, and we're going to look at AR. ARCC. All right. So this is ARCC's option chain. It's a business development corporation like Mitt Romney used to run, like Bain Capital. Has a very thin option chain, but you see delta, mark, ask size, bid ask, all the metrics we're used to looking at. So over here in this little applet, it has the same things. Bid ask, expiration strike, bid to ask ratio. And this is important because I don't want to have to do the mental math every time. So it just calculates the ask, the bid divided by the ask. And that tells me that that strike is more tradable than this strike. And then it has the Greeks out here. And I don't pay too much attention to them, but it's good to have it all in one place. What I wanted was the ability to look at this rather than having to scroll up and down through it, is more like a calendar where the expirations dates ran across the top, the strikes ran down the sides. So we created that with expiration and strike, and then we took the midpoint, which is at every single intersection where there is a contract, and then we overlaid it with bid-ask ratio. So this gives you a sense in this particular option chain of just how much is there. And there's not a lot in terms of possibilities. This is sort of the clean view of it. And then we can put liquidity and layer on top. So these green shadings mean that these are 80 to 90% bid to ask in those intersections, but anything in white is less than 70%, which means I'm never going to get my price. Now I've bookmarked Dow because I thought it'd be a good example for everyone to see. And here we are at the bottom at the money line. And there are many, many more strikes and expirations in Dow than ARCC. It's easy to see. The liquidity isn't particularly great, okay? And of course, let's show you the best stock of all time right now with NVIDIA. And this gives you then a view into NVIDIA that look how it's all deep green. Everywhere we go, at every single expiration and strike, we have high bid to ask ratios. So this is definitely has been helpful. It's taken a long time to develop, but I use this now. I also have an ability to look at liquidity this way, where I've divided it up into tiers. And this helps me to know where the liquidity is, where tiers, which is I'm looking at call contracts that are out of the money. So we're above they're out of the money, so they're above the I gotta get this right. Let's just say they're out of the money. I don't want to get myself wrapped up right now. So the calls are out of the money. This was snapshot 10:30 this morning, and you see like Tesla has 1,600 contracts that are calls out of the money right now. 59% of those have high liquidity. If that's in my price range, it's a good bet. It's got higher volatility. It's a good bet that I'm going to get into it because we'll see that. And we'll see the same kind of patterns with different companies as well at different tiers. But the point is that as you start moving down towards the bottom where the liquidity goes down and the contract count goes down in particular, I find anything less than 499, less than 500 active contracts is not going to be very tradable. So I will typically go back and forth between this screen and it'll jump me into my at a glance view. So I have a sense of this, okay? And then finally, we've built an ability to look at the best premiums. So if I were selling puts, I'm running through this quickly, but I can now look at all the puts and say who has the best premiums right now. And then the rest of this detail tells me how much my capital outlay is going to be and what my premiums would be and the return if exercised and so on. But I found this thing to be hugely helpful, especially because I'm going to recommend to you in developing, as we move into now the fundamental side of and move away from liquidity, I want to show you how we can easily get to looking at the fundamentals from here as well. But I've done it both ways. And for people starting out, you can use the approach that I showed you up here in your platform, and it can be very efficient. You know, if you sit down on a Saturday afternoon for an hour, half an hour, you will very quickly crack through and say, hey, these are some targets for me. All right. So let me ask now, John, it is time. Let's review some of these stocks that came through, because I know everyone wants to see it. All right.
All right. Yes. Let me just get to them. And there are about 16, 17 answers. So I'll just, do you want to comment on each one, or you want to get them in a row?
Let's take them on and see where we get. It's 12:43 already. Wow. How time is flying. Okay.
So I'll just click through them then.
Yeah. Just give me like 5 or 6 and I'll take them, because I want to be sure we can get through the second, our poll result.
Well, I'll show them all, since people have taken the time to respond here. And it's a lot of different tickers, actually. Not many repetitions here.
All right. Where am I going to see them?
You see them on the StreamYard screen.
In the comments?
No, on the screen where you see me and you.
I'm looking at my...
But you see them in the comments too, as starred.
Oh, I see. I got to go all the way back here. Okay. QQQ and SPY. Those are going to be the most highly liquid of anything that's out there. There's no question that they're tradable and worth looking at. mRNA is one that I have had in the, Moderna. Yeah, I've had Moderna in the past. And I would look at it this way. You can see right here, not very tradable. Okay. Not a lot in the way of the option contract. The fundamentals may be great, but it's going to be a hard one to trade. Okay. Dell, fantastic choice in terms of liquidity. And what we're really answering here is the liquidity question more than anything else. But this is good for you to get a look at. And just to say, like, look at Dell's liquidity versus mRNA. Okay. Now, I do want to say, beware of the strike holes. Anytime that you see this white area in between, there are holes between the strikes, and they are, in this case, they're 10 points apart. So that impacts your tradability. It's important to know. And my strategy when I see strike holes like this is to try to stay as close to the left side of the chart as possible where there are no strike holes. Yeah, this gives you some a view into Rivian, which I've traded in the past. It's decent. It's not highly liquid because you can see the lighter shaded greens here, but nonetheless, it's a fairly deep option chain. It goes out to December 2028 out here. And, you know, if you stay in close, you're going to do well with this particular stock. AAG. I don't know if I'm getting all of them, but I'm going to try. All right, AAG, not very tradable. This is going to be a hard one to wheel. All right, now let me take you on from here, because I need to take us through the fundamental side of this discussion and get us onto this for lack of time. All right, in the fundamentals, I look at the following. I look at sector industry trends. So AI revolution, we all know that's going to be a big one. Revenue trend and EPS. Is the top line increasing? Is the bottom line increasing? And can I buy the stock at a reasonable price? So I like Earnings Hub and Fast Graphs for this. This is a snapshot from Earnings Hub of Microsoft. And just pay attention to these kind of, if you're on a mobile device, just pay attention to the direction. The direction of revenue is up. The direction of all these green dots is up in terms of EPS. Guess what? Over a long time, the direction of Microsoft has been up, okay? And why? Because there's a correlation over time between EPS and the price of the stock. And sometimes they get out of sync with one another, and I can tell you half a dozen right now that have. CRM, Adobe, I'll come up with a couple more, but those are some big names that have done well, but they're flying underwater right now. Now, the other side of it is here's Southwest Airlines. No real trend in revenue at all. No real trend in EPS. And this is Southwest over 10 and a half years. It has been kind of a nothing bomber. And I've owned it and I've wheeled it, but it hasn't been a great stock to be in any way, shape, or form. Now, let me do this out of here. You've seen this, and I want to show you how this can work. I bookmark 2 sites that I really like, and one of them is going to be Earnings Hub. So I can come in here, and if you're using Earnings Hub, I'm just showing this to you. Comes in, it gives you kind of an at-a-glance view. This is the free version of it. And suppose I want to look at Okta, which is a stock I like. This is another one that the stock is doing, or the company is doing great, but the stock has done poorly. Okay, so continuing revenue, they are beating revenue estimates 17 out of 17 quarters. Earnings 15 out of 16 times. They beat the estimates. Love it, right? So I look at that. The next one I like this site. It's kind of expensive, but it's worth it in my book. It's called Fast Graphs. And so let me get logged in. Let's go look at Okta. But I'm always looking for the same exact thing to get started. I'm saying, is there a decent trend in the industry or sector? And what do I think is going to happen with this stock over time? But I'm always looking at revenue. Here, start all over. Revenue and EPS, numbers 1 and 2. And then I like to look ahead and say, well, what is the trend on these stocks as we look ahead? Let me take something more like Microsoft, just because everyone knows it, okay? What I like about this particular stock, what I like about this site is that it gives me the look ahead into EPS. And many of the sites like Earnings Hub is now doing this, but they tell you 23%, 16%, and 18%, 26, 27, and 28 fiscal years. I like having visibility to that. And there are all sorts of other things that they do, like they score each stock with a visual like this. So I'm not the simplest thing, if you don't want to buy the subscription, is use Earnings Hub free version. And then once you have this URL, you can just double click on the ticker and change it to Microsoft. And now there it is. So definitely useful. I look at this just all the time. Now, John, we had we've got about 8 minutes left, and I'd like to be able to get through some of the questions people had about my trading style and what I do. So let me take that on. I guess we have a choice of doing a poll or giving people this kind of information. So let me do that.
Let's just show the poll we had first, and then we'll take a couple of the questions that we have gotten. But we asked about what concerns you most about using options strategies like the wheel, and basically people are either answering the capped upside, that's 2/3, and I need to understand the process better. Okay. I guess it should be. So that's the response to that one. So we have one here about from Vijay. Instead of getting shares assigned, can we play protected? Can we buy leap 1 year expiry at the moment?
You know, I have done that before, where I've converted my long stock into a long leap option, and that has been a decent strategy. I traded poor man's covered calls for a while, and I sort of got out of them because I got tired of the management of the longs, where the theta decay on the long always goes to 0. And so how do I make up for the decay in the long? Well, through selling lots of shorts and making money on the short side of selling covered calls on the long, or the price appreciation. And it's a trade-off. So I kind of got out of that. There's a question, do I have any rules about running the wheel on stocks that are up a lot or at the money? Intel, all of these. I'm trading all 3 of those right now, except for Marble. And I would say this is, you're going to have situations with these stocks where you will need to roll for a debit. And I'm going to show you examples of some I have right now where I've taken some significant debits, but it does not bother me, and it shouldn't bother you. If you zoom out and you say, over the long run, what I'm expecting to get out of this is, like I showed you the other day, a pie chart that looks like this, where I'm making 3 to 1 or more on the dividend. And then I have a trend that, starts here in the middle and travels up. That's your target. So as long as that's good, you're in good shape. Okay. And let me move us on, because we're at the edge of our time.
There is a question about your Microsoft.
If it blows through my Monday, if it blows through my Monday covered call, will I roll it? Or if it blows through my Monday covered call, I will let it go and start with a new CSP. I'm going to take that 2 ways. I have typically traded the wheel, and I divide my wheels into 2 categories. One is the classic wheel where I'm in and out like that. The other is what I'll call the wheel forever strategy. So on stocks like, all these AI stocks that we see, I'm into those for the next 20 years. So I don't mind, just from that point, if it goes way up, just rolling up for a debit. Doesn't bother me at all. I'll do that. I do that quite often. Okay.
And the last question I think we have here is, in what range of IV you trade?
Good question. And I typically prefer 35 or higher. I find 35 or higher, there's enough volatility in the stock that I can make a buck on the premium. 35 or lower, you start getting into like the Walmarts of the world, and you saw the contrast in Walmart versus Palantir, I think, earlier, and that is completely due to volatility. All right, everyone, so I'm going to end on this and then give you some homework. These are some trades that I have played, and I keep this scorecard on every wheel that I have exited. So what is it showing us? I have invested 20 grand in this stock. I held it for 664 days. Annualized, my wheel made 10%. Buy and hold, 1.3. How did this happen? I sold $1,900 in premium. I collected $2,800 in dividends. We do the math on the actual raw return. We annualize it and so on. And what you'll see is that I keep track of the transaction log as well of everything that happened in this trade. So I'm going to send this out to all of you. You'll get this workbook and get a quick look at it. What we see over here on the right is the gold. This tells the story. The story is that on ARCC, it's a very thinly traded option chain with like 6 expirations, but I got into it because I wanted the income. The gold line is the dividend line. So anything collected down here is reflected in gold. The total of income from dividends and rent is shown in green. Stock price is down here, and then there's sort of a green line on top of here that tells me what my strikes were as I move them around. You see this more pronounced in this stock called Vistra, which I picked because of Nancy Pelosi and her stock tracker. And I've done 11.9% on this bad boy versus 0 if I had simply bought and hold. Lots of transactions, and you're going to see in here, like I am rolling all the time. Sometimes, like on this day, I rolled twice. And I'm just making very incremental adjustments. You can see in the chart right here that this is my purchase price in dotted, and this is my strike price. So I'm following this price as I roll. And I'll tell you this much, there was a period of time where I said to myself, I am only going to keep my strikes above this dotted line, my purchase. And one day I thought, I'm just going to try rolling. And then after 6 months, I found that my profitability went up by 50%. Okay. So if I was making $50,000 now, because I was rolling below that dotted line, I'm making 75. So I'm going to roll, right? But if you're going to roll, you better have a tracker, and you better know exactly where you are in the trade at all times. If you're going to roll below that purchase price, this is something we're going to talk about next time. So I'm going to give out this workbook, but let's dive into some of these others. NVIDIA, hey, this one, stock price is moving all over the place. It had a nice uptick. It's been pretty flat this year, actually. But notice in here, I'm taking debits along the way where I roll up. I kept the same expiration here. and I rolled up to from 190 to 195. It looks like I rolled out, or I rolled back in because the stock price probably came down, and then I rolled down again. And I am all the time adjusting these. And NVIDIA would be a class of stock that I would call my wheel forever stock, that I'm just going to keep bringing in premium. And the results are that I have done 48.5% annualized versus 35. Now, next time I'll show you somewhere I'm underwater, but you'll see the same thing if I look at Broadcom. You know, I've got $1,000 debit right here. But when I'm always zooming out and I'm saying, how's my P&L? Do I still have that ratio that I showed you in the pie chart? General Electric stock has done relatively nothing, but all the while I'm collecting premium all along the way. And finally, this is an interesting top of the wheel stock. And then I'll end on this, is to say, this is SMCI this year, nothing bomber. Started at 30, ended a little bit below 30 last night when I snapped this. And in terms of what I've done, let's look at the bottom here. I have only sold cash secured puts on this stock since the beginning. I have never owned it, ever. And I have generated on a $32,000 investment, I have generated $19,000 in capital. And I just keep rolling it and rolling it. It's 135% annualized versus nothing. Now I'm going to show you some next time that go the other way, but I'll give you this workbook and you can comb over it and tell me what you think. But with all that, let me just take us to the last piece. And John, you'll keep me honest about anything else we need to cover off. But we do have some homework. I just can't find it. John, do you want to share that with everyone? We'll share it in the notes, but I've got some homework for you to now go out and tell me who you would trade right now. Everyone, session 3 of the wheel starts now. We have covered much groundwork in the past couple of weeks, so let's get on to it. Today is session 3. You can see from our legend here that I've color-coded what we've covered and in what sessions. So we'll just jump right over to session 3 right now, and I'll give you the updates. Today we'll do a review of sessions 1 and 2. I want to go through the homework, talk assignment. We'll track those trades we've been working through, have a couple of polls. Rolling is a big point of discussion for today because it's a big deal in terms of trade execution and how profitable you can or can't be. Now, let's talk through. Here's the review, the quick review of everything we've been through so far. Remember, hey, ChatGPT, what is the average dividend yield among the Dow, S&P, and NASDAQ, the 515 stocks? And the answer was 1.2% average dividend, meaning that $1 million translates into $12,000 per year. Tough. Well, what if we could generate $12,000 a year with $100,000 in capital, or $1,200 a year with $10,000? Enter the wheel with the ability to make money through growth, income, and rent. And then we discussed the real estate parallels, and then we worked through the wheel framework itself. And so we've gone through each aspect of the wheel with the Silto list, top of the wheel with cash secured puts, bottom of the wheel with selling covered calls. And there are details on all of this in the earlier videos. We talked through liquidity last time in terms of building our Silto lists, as well as fundamentals. Moved into discussions of what does it mean to have a cash secured put if you don't own the stock. It's called selling a naked put. Covered calls. Why is it covered? Because the stock is the collateral at that point, and we're covered in case there is a call. Making money at every base. This has been one area that I've worked through over the years to try to make money. Lots of singles, doubles, triples, and if I can get some growth at the end, I'm happy. And then I gave you trade examples, probably between this and the Excel spreadsheet, probably 15 different examples of trades in all different aspects of the wheel. We had a tracker, which is necessary to know exactly where you are in the trade at any point in time. I've actually added some columns to the tracker today that will be helpful to you as we move through. And of course, Norway rules. Now, session 3, let's get down to it. In terms of the homework review, I'd like you to start putting in the chat right now how you came out in terms of some of the ideas. We talked about liquidity and fundamentals, and I asked you to develop a SILTO list. So if some of you would, or all of you, if you've got some stocks you'd like to talk about that you picked, let's get a look at them right now. INTC, okay? Let's get a look at Intel for a minute, okay? Now, I brought up this tool the last time, which I like because it helps me much more quickly to determine what stocks I like, and especially liquidity in the option chain. So why can I not find Intel here? Intel, okay? So let's get a look at Intel. All right, and this is the typical option chain view that you're used to seeing in TOS with bids and asks and deltas and gammas and all that. Let's look at this at a glance for a moment and get a look at Intel. Okay, now I'm going to turn on my liquidity heat map here on Intel. And what I see in this chain just right away is that it's very liquid. These dark green boxes actually mean that there's liquidity of 90% or more at any particular position. So any of these that I'm marking off that are dark green. So this is a chain I would like from a liquidity standpoint. Let's go look at the fundamentals briefly in Earnings Hub. And the stock its revenue hasn't, just kind of looks like it's cyclical is one of the things I see here in looking at the ups at the beginning of the year. And the earnings have been hit and miss, but nonetheless, I like Intel. It's a long-term planetary scaler. I think it's worth looking at. Next stock. Do we have another one, John?
We have many.
Yeah, ARM. Okay, I'm into ARM right now. I'm into Intel as well. ARM Holdings.
We have about 10 different tickers, I think. So if you want to go through all of them, or we'll just flip through.
We'll take on a bunch of them, okay? Now, the thing about ARM versus Intel is as we look at this option chain, notice these strike holes right here. In Intel and Microsoft and some of the more liquid stocks, you're going to have less of that, meaning there'll be fewer holes between the strikes, which means it's more tradable. I've traded this. It is a high liquidity stock. I think its volatility is probably north of 40, and that means you're going to get it in both directions in terms of the ups and the downs of the stock. But I like it. Let's take a look at the fundamentals. Just a very quick look at Earnings Hub. And this is one, again, it looks kind of the earnings, 10 out of 10 quarters, revenue, 10 out of 10, EPS, 10 out of 10. It's part of the AI revolution stocks that we have going on right now with this super cycle. So I'm all in on ARM. What do we have next, John?
Palantir.
Palantir, okay. Palantir, the last time I looked, PLTR, right? PLTR. The last time I looked, its volatility, its implied volatility was like 56. So beware if you get into Palantir that you are going to be in for a ride. But we see the same thing here. The at the money, it's trading at 119 right now. And I like the liquidity herein. If you can trade Palantir and stay like a month, 30 days or less DTE, you will have a lot of choices for rolling, which is a big deal. You start getting out here north of 30 days, like 60 and later, then your choices for rolling are much, much less. Okay. Next stock, John.
NVIDIA.
NVIDIA. All right. I knew I'd be hearing about this one for sure. All right. This at a glance view has made a huge difference in my trading and my ability to research stocks like this. Liquidity, on NVIDIA, say no more, because there are something like 1,500 active strikes on the call side and about the same on the put side. It's one of the highest liquidity stocks. It's one of the highest volume stocks. It dwarfs everyone else in volume by far right now. And so, and look at this liquidity up into here. Now, this is the interesting part on liquidity. Let me turn on Delta for a minute. So these are deltas that are between 15 and 25, meaning that the likelihood of being assigned for the July 10 220 is somewhere between 15 and 25%. And you start to see that this liquidity, it goes way out into, let's just go to December of this year. So this is 25% delta. This is 15 top to bottom. And you can see like there's a whole corridor here that I would say there's a decent chance that the stock could move up into this zone, because if these are like 15 to 25%, these are higher. I mean, this at the money is 50% delta, right? And so when I turn on the liquidity and then I see that across this, there's deep green everywhere, it's obviously a keeper from an option trading perspective. Liquidity is number one.
We got Netflix.
I've traded Netflix as well. I've made money on Netflix. NFLX, right? Yeah. 1 second here.
NFLX.
All right, we'll take two more, and then how many more do we have, John? Probably a bunch.
1, 2, 3, about 6, 7.
Yeah, let's take a couple more, and I'll come back to this at the end of the session for sure. Okay. Now Netflix, you can see in here that there's good liquidity here all the way out to September, right? So this is September. I love this kind of stock, this kind of option chain where we have this kind of deep liquidity across a multi-month time frame. It says to me it's a winner in terms of stock pick. Let's look at what Earnings Hub tells us on their revenues and margin and EPS. So the revenue trend I love. They've beat estimates 12 out of 17 quarters, and EPS they've missed a couple of quarters, but the 13 out of 17 is a winner for me. And I think the trend in digital media with a stock like Netflix is here to stay. If I zoom out on Netflix or any of these stocks that we've just reviewed, my general feeling is that the bias is up and significantly up over the next 5 to 10 years. So when I get into my wheel, my perception of my bias has to be, hey, I'd be willing to own this for that amount of time. What do we have next, John?
We have O, which is
this is
Reality, REIT.
O Realty. I'm familiar with them. Right? O Realty. Let me find Realty. Let me just put it. It has to come back. Nothing like doing it in real time. Let's see. Realty. There we go. All right, now, I had commented on this the last time. This is a great contrast to the other stocks. If you're getting into O, what you're betting on is that you want the dividend. It's an REIT. It pays a high dividend. And so I have one like this that's called ARCC, and it has a thin option chain like this. So my counsel to you is if you're going to get into it, try to sell out of the money and stay there. I would not roll below your purchase price if the stock should go down, simply because of the fact that you may have a hard time rolling out of that position if you need to move from one position to another. So just be aware of that. And let's check out their finances quickly. What does Earnings Hub tell us? Again, look at this, beautiful. I love to see this pattern in the revenue trends, and their EPS is continuing to move up. They might have missed those red dots on the right. They might have missed by a hair, but the stock continues to move up over time. Now, I will also say, let me use this as a way to give you some more information. I can here pull this into a separate window, and then I'm going to open all these research tabs. This is a real winner for me, because what I like to look at right away is Wall Street Journal. Are there some YouTube videos where I can learn about the stock? What's happening in terms of analyst forecasts? What do we see in terms of revenue growth? And look at this, since 2021, they've more than doubled their revenue in 5 years. That's a big winner to me. When I dive into margins down here, I'm looking at gross margin, operating margin, and profit margin to say, how are they doing as a business? And the answer is pretty well. So, I like, but just beware when you go to trade it that you have to be careful about rolling below your purchase price if it should go there.
We have also QQQ.
QQQ. Need I say anything about QQQ or IWM? It will be the deepest option chain next to NVIDIA that you will have seen, and IWM will be likewise. There's really nothing more to talk about. It's a great chain. I haven't look at this deep liquidity out here into September and October of this year. That communicates to me, I think this is a leading indicator. It's highly liquid, and let's see what its deltas are telling us. Its deltas are telling us that the bias is definitely up in terms of tradability. Yes. What next, John?
DY?
DY. New one for me. Is that like Dollar Tree?
I don't know.
I do not know DY. It's not coming up yet. All right, go on to the next one. I'll come back to DY in a bit. Okay.
The next one is MU.
Micron. For the gentleman who put in DY, just tell us who it is, okay? All right, Micron is going to be much like, it would be much like its counterpart, NVIDIA. I mean, look at this. This is beautiful, okay? This is a stock, and I don't even have to look at their earnings hub, but let's go look anyway, right? It is going to be fantabulous. Look at that up spike. And actually their earnings is today, by the way. Now, a little spotlight on Earnings Hub. They have, when I come in here, an earnings calendar. And in the free version of it, it gives you a calendar every day of who is reporting before, during, and after close. And I love it because it gives me an at-a-glance version. Then you can just click on, like FedEx's, was yesterday, and you can go look at their data at a more detailed level. Okay. All right. Anyone else, John? And then I want to get us moving on.
Well, I have still 5-6 more. So
yeah, I'm gonna have to. I'll give us another minute. Okay, and then I'll go.
Okay. And we have Adobe.
Adobe. Now, Adobe, I currently hold a position in. It is a stock that, from a valuation standpoint, is at a price that I would like to own it at a fair price. And I think Adobe is at a nice valuation buy right now. Its option chain is not as liquid as I'd like it to be. But nonetheless, when I go out and I look at Adobe, I've reviewed this recently, so this is not new to me, that Adobe has hit earnings quarter after quarter after quarter after quarter, and they've made their revenue number quarter after quarter. And let me show you this. I'm going to jump over into Fast Graphs, which is an expensive subscription, but I want to show you Adobe because I was reviewing it in preparation for this discussion today, just knowing that someone might bring it up. Right? In Adobe, what I like about Adobe is that, first of all, if I zoom in slightly on this, you can see that they are projecting into late 26 through 28 of having double-digit growth between now and then. And again, let's rule of 72, this 17% means you're going to double your money every 4 years with Adobe. And it is trading at a low PE of about 11 right now, and this is fair value up here of 31. So I'm believing there's stocks like this, like CRM, that are prime for growth once that the market changes its tenor a little bit towards value-based purchases. What else do we have, John?
Avgo, AVGO.
Broadcom, indeed. Okay.
Broadcom. Okay.
Yeah. Another planetary scalar AI darling stock that, again, when I look at this super cycle we are in the middle of, you're going to see this kind of pattern. It's not as tradable as Micron or as NVIDIA by far. Go back and rewatch the video a little bit earlier. You'll see that those two stocks have very much less in the way of strike holes here. But nonetheless, it's less liquid in the very near term, like less than 30 days. So you just be aware of that, because on Broadcom, it means, let's say you are trying to get $5.15 by selling that call as an example. You're probably not going to get $5.15. This colorization means that the bid-ask spread is 70%. So you're going to get closer to 70% of what you're asking for than 100% of what you want. All right. I'll take one more, John.
One more, I'll take the next one from same person, GEV.
B. Oh, another one. I own the GE version of this. I don't own the GEV version of it. But what you're seeing with GE is if this is the one that's directed towards space exploration, they're doing a lot in that area. Well, okay, evaluating the option chain, just to give you my quick take, is beware of the strike holes, right? And here's the thing. You don't see these strike holes when we look at the option as a chain this way, right? I can page through this thing all day long, and it's not going to be, I will not easily see these strike holes, which is why this at a glance view has been very, very helpful. So you have two issues. You've got strike holes out past 30 days out here, and then 80% bid to ask ratios is what these mid-green colorizations mean. So it's not going to be as tradable as you might imagine. And even though as a stock, as a company, what is Earnings Hub telling us? Earnings Hub is telling us that they've done well with revenue. They look like a cyclical kind of seasonal business, or they have a big fourth quarter, right? This is what this tells me, which is not bad. I work for many companies that have had big fourth quarters, and they just continue to build revenue throughout the year. Look at their EPS, it's going up, so the stock price will soon follow if it hasn't already. Okay, so this has been, I'll come back to these, and if you want me to do more, I'll do more next time, or if we have time at the end of the session, all right? Let me take you through, I want to talk briefly about two big areas today, assignment and rolling. Now, I'm talking for a few seconds on assignment because the trades, the live trades that we have, as soon as we talk assignment, because we were assigned, I'm going to then go into that and we'll work through those live trades. And then we'll get into this whole rolling discussion after that. So a few points on assignment. And for anyone who's trying to just get the terminology, what is an assignment? Think of real estate. If you were the seller of a property and you make certain commitments, and then it's not easy to back out without having to pay a big fee in the real estate business. You have an obligation. And it's the same in the options world when we look at the parallels between the two. That assignment happens when the seller of the option, you're required to fulfill the contract's obligation. When does that happen? When your contract ends up in the money, either at expiration or before expiration. In American style options, if your call or put go in the money, if it's a short call, you sold a call, then you must sell 100 shares at the stock price and give it to that buyer of your option. If you own the stock, it's called a covered call, and now those are assigned to the buyer of the option, and you get the cash at that strike in your account. And it's the same on the put side. In this case, you have to come up with 100 shares, and that's why when we sell a cash secured put, that cash acts as collateral until the disposition of the contract is known. And just let me say this: I have a couple points down here about when does this occur. 99% of the time at expiration, but I have had about 1% of the time, and I remember who those stocks were. It's called early assignment, where the buyer of the option says, hey, that stock went up. If it's a covered call, I want to take it right now. And so they have the right to take the stock and assign it to themselves, close out their contract before expiration date. So just be aware of it. It doesn't happen much across my 10,000 plus transactions. Like I say, I can remember half a dozen at most. It doesn't happen often, but beware, it can. Okay. Now, and just the last thing on assignment, I have another slide behind this that you can read later, but the buyer, this is divided into the buyer over here and the seller over here. You will hear terminology about the buyer has the right, but not the obligation to do something. And that on assignment, the seller is obligated by the contract. So just be aware. I think this is a great summation. And then I've got this slide, which you've seen in an earlier session, and then 2 examples that follow, okay? Questions on well, I guess there's a lag. So if you have questions on assignment, put them in the chat and John will bring them up when they come up to him. I know there's a bit of a lag as we go, okay?
But there is a different question that's waiting if you have time for it.
Let's take it.
That's from Brett, who's asking about the feasibility of maximizing wheel premium by selecting strikes close to at the money.
John, I like that idea. The idea that John is conveying to us is that he is wanting to sell calls or puts right near the money. So let me give you the visual on that, because it's a good one for everyone to just have in their thinking. Here we go, clear sense. All right, so let's say we're talking about GE Vernova, right? So here the stock is trading at 1,052, and he's saying, hey, on the call, let's say I own the stock, I want to sell this July 17, 1055, because I can get $54 close to the money for this. Wow, that's a big deal. So yes, I've done this before. I have a trade that I call the at the money trade, and I'll do the reverse where I'll sell on the put side. I'll sell the put below the at the money line, and all he's saying in his question is, well, what would you do about selling a put like right here, close to at the money, because the premiums are much better. I've done it. It's worked quite well for me, and I would just say that because you're close to the money, like when you sell your call, try to sell it out of whatever you do, try to sell it out of the money so that you don't end up in a negative situation if it's early assigned. Doesn't happen often, but definitely have done it. Any other questions that are sitting out there, John?
No, there is not, except there is one question coming in now, but let's just take the one I was that you can answer very quickly. Is this sheet for option analysis available? You have answered that before.
Oh, indeed. Okay. Yes, the sheet, meaning
Clear sense, probably.
This clear sense, yeah. We'll talk about this more in session 4. This is a tool that I built for myself, and I've now had a lot of people ask me for it. So you can just pay attention to this URL. You can go there and sign up for a little test run of it. But we're looking at marketing this as a tool that will help people in this kind of analysis for sure. Okay.
Then we have one question from Roderick. How does dividends that ex-date prior to expiration of short calls, for example, change either the management of, or does a dividend become a filter prior to entry of the trade? I got a bit lost here, but hopefully you...
Okay. Well, this sounds to me like a dividend capture strategy where I mean, maybe that's not exactly it, but I've had this happen where I have dividends that I know are coming in, and I have the ex-dividend date, and then I have an option that's expiring after that date, right? And so in the management of that trade, the main thing is you must have the stock the day before the ex-dividend date. And then I have had these ones get early assigned because someone says, well, I got the dividend and the stock went up. I want to take the profit on it right now. And if I'm sitting on the other side of that option, it gets assigned on me. It has happened a couple of times, but I like this idea. It's a bit of a market timing thing, but I have used it before and it has worked well for me. Let's see what happened with our transactions. All right. With our trades, we had a couple trades brewing, so I need to manage those for you right now. Now, what we had 2 trades. So at the top of the wheel, we had a situation where ServiceNow, what happened to it is it expired on the 18th of June. It was below 98, so the stock was assigned to me. So what I did here is I noted that, and I exited this option contract, this CSP, and now I need to do 2 things. I need to show the assignment in my transaction record. So here's how I do that. I'm just going to quickly add these, and then I'm going to say, what do we have here? We have the stock that we got into We did a buy to open is essentially what happens on over the weekend. Let's just say on 6/19, and the price would have been $98 because our cash secured put was at 98. Okay, so that takes care of part one, that now we have this stock sitting out here. Now what we need to do is add a covered call to it. Okay, now notice in the tracker, it's smart enough to go, okay, this transaction is now closed. This is now an active transaction. And now we go over to Thinkorswim. Okay, and here we're going to go do a trade. And I already brought up now. And let's look at the option trade, the option chain. And what I'm looking for here, we talked about delta last time, that one of its meanings is it's an approximation. It approximates getting a sign. So I want to be down here at about 20 delta. And that says I'll probably get 67 cents is the midpoint. So let's go trade it. We're going to sell a covered call. So in TOS, I just click on it, brings it up. I've got to adjust the number of contracts and to 1. And then you can see here, this is saying 65. I'm going to go up a little bit higher towards my midpoint and confirm and send. Okay, so I'll get $67 on this trade is what this tells me. All right, and it filled. Beautiful, okay? And it filled for 68 cents. So and what did I do? I did the 26 June 103. Someone remember that for me. The 26 June 103 at 68 cents. So this is going to be 6/26 103. And I did a sell to open on 6/23 at 68 cents. Okay. And then the rest of this, I just need to fill in. And so this is my active position now this way. And the most important part about this tracker is that what it gives us is the ability to track this trade right now. Okay. So we can see, if I just zoom out a little bit, that the stock is trading at 97.23. I got it at 98. So we're at a small loss right now. We brought in $75 on our first CSP, and we got $68 on our covered call just now. But if I had to buy it out right now, I'd pay 73. So I'd lose 5. So I'm netting $9, $11. Okay. And like I said, you have to have a tracker like this. And I built this for anyone running Thinkorswim on Windows because it'll help you to trade. Now, let's take a look at the other one, which was in the bottom of the wheel. So in this case, we had a Microsoft. I had purchased the stock previously. And so this trade, what happened, it expired out of the money at expiration. So all I have to say here is this expired, and it expired on 6/22. I think was the date. So done with that trade. Now what we have to do is we have to add a covered call on Microsoft at 20 delta, right? And let's just take that on. I have too many windows going on. They're just going into my P-Trade account now. All right. And we'll go to trade. We'll go look up Microsoft. Right. And I would look this over beforehand. The dates we have on expirations, today we're sitting at the 23rd. Okay. So I'm going to I would never normally do this. I'm usually going a week out or 2 weeks out, but let's poke it for tomorrow just so you can see the transaction, and then we can track it when we come back on Thursday. Okay. So we're going to choose the June 24. And June 24, I'll do the same thing here. I'm looking at 20 delta, 19 delta. This is the 380, and our midpoint is 80 cents. So there's pretty good liquidity between 81 bid and 78 bid, 81 ask. Let's go ahead and trade this, okay? Or sell a covered call, all right? And we'll do the same thing. I only have one contract on this bad boy, all right? So 24 June, 380, confirm and send, done, okay? So 24 June, 380, and we got 80 cents, right? So now, 26, 24, 380, and 80 cents. Okay. And again, this is going to be a sell to open transaction that we carried out on 6/23. And then all I have to do is copy all this stuff. This is it's just another covered call. Okay. Now, what I want you to see here in the Microsoft transaction as we go to the right is that, what did I do? I put in a number, a bad number. This should have been 0.8. It's telling me I was far too profitable than I should have been. Okay. So this gives me a sense of where I am in the trade right now. Okay. The stock is a little bit underwater. I've brought in 100 and, if I exited the whole trade today, I would lose $1,100 and change. But you see, I've brought in some premium here in terms of $194, and I'm just going to keep trading this thing. That's how I do these trades. I'm not at all bothered by being underwater at all. These are, and I always have to go back to my premise when I say that. All right, any questions on this before I move ahead?
There is one question from Clifford here. What do you do when cash secured put assignment happens and the stock price is way down? Do you buy another CSP to average down your entry cost, or you sell a covered call for a small premium?
Answer is I have typically rolled down and out, and this was Clifford. So Clifford, I'm going to come back to you in about 2 seconds because we're talking about rolling next, and you're giving us a nice segue into the next question. All right, so stay tuned. We'll come back to this tracker when we come back on Thursday. Okay, let me take you to the Clifford's question because this is a big deal. Rolling. This is adjusting a contract without exiting. And it took me one day, no one told me this, and when I created this at a glance view of the option chain, all of a sudden the terminology made sense. So let me review this quickly. The terminology related to rolling, it's all about adjusting risk. And you'll hear people say roll up, roll down, in, out, down and in, roll up and out, roll up and down, that sort of thing. What does that all mean? Well, what it means is that if we take our standard option chain that we view this way, and we begin to pivot it where we put the expirations in the columns, the strikes down the rows, and the midpoints at the intersection. So it looks like this, which you've been seeing. Now imagine I have a position, the 17 July Microsoft 405. I want to roll in. I'm rolling in time. That's what they're meaning when they say roll in. I want to roll out. I'm rolling out in time. And you'll hear people call it a calendar. Guess what? Vertical is up. Vertical is down, and then a diagonal. Look at this. All right, I'm up and out. So if you have two positions, like some kind of straddle or anything like that, that's a defined risk trade. When you put those two trades together, you're creating a diagonal. You're creating a vertical, whatever on that. But here, it's very simple. But this is where the terminology came from. Now, there's a whole other discussion to be had around this. About I start at this 313 midpoint right here. I start at this, and now where can I make money if I'm moving from this position to another option? And when I'm rolling it, meaning I'm buying out the 313, the 17 July 405, I want to ixnay that trade and get rid of it, and I want to sell another call. That's as I define a roll here. So there's a whole discussion. Look over these slides and go, well, I can't make money moving in that direction. Oh, I can make money moving out in time, but now I've got to think, well, is it going to hit 405 by 16 October, right? And then you go through the same mental logic with rolling up, rolling down, doing diagonals, and so on. So I like to show this slide because it's a great way for people to envision what the terminology is around options. Now, Clifford, back to your question. Here are 5 scenarios that we'll walk through together, and I'd like your input. What would you do? And let's take them one at a time. These are actual trades that I have been in the middle of, and one of them is live right now. The AVGO trade in the bottom right here is live right now. So let's look. What happened in these trades? Let me unpack this slide so that you know what you're looking at. First is we have This is Valero. And it's the Valero 3360, which is my unique identifier for this trade. I traded it. This was my purchase price, the gold line. No sooner did I buy it, cave, right? And then it bounced around. And by the time I exited, it ended up being at par. So my question is, for those of you looking at this chart, what would you do? Would you get out? Would you what? What would be your natural inclination if you're sitting here and you get in and boom, you're now down in this crevice?
Tim is responding to this. If I had the capital, I would buy more so I could sell 2 covered calls.
Okay, and Tim, what is behind your decision to do that is a premise that you think that that's a value buy at 64, at that 30% crevice. So, okay, we have others? Other comments?
Pete is would keep.
You keep it? Okay. Anyone else?
And Chris would roll out,
and down. Let's see. Okay, well, could be. If I don't know. Yes, if I'm on the CSP side of this trade, which I would have been at the beginning, I probably rolled out and down. Now, in our prior session, I gave out all those examples. Here's the scorecard of what actually happened in my trade. I invested $24,900. I held it beginning to end, was about 2/3 of a year, and I made nothing on growth. I made $1,800 in premium, brought in some dividends, and I made 15%. And then on the buy and hold side, if I had just simply bought it and held it, I would have made 10.3. So I have a little calculus of how I get to my purchase price. But either way, I won versus buy and hold in this particular case. And there's a whole nother discussion. I'll provide you with this trade in the session 3 notes so you can actually see all the rolls and transactions that I made. But I held on because my premise said to do so. All right, what about this one? This is AMD. This is AMD 9311, and same kind of pattern, only this time more pronounced, 50%. There's my purchase price, and it was kind of like nothing bomber until just recently. And this is end of 2025. End of 2025, it jumped up quickly. All right, so what would you do on that one?
And while we wait for the responses to that one, I can just show the last 2 that were from the previous example, where you had wait until recovery, and you had Gobela who would run.
Okay, I have had that emotion, by the way, to run, absolutely, and I have run out of some of them. But I'll say that I've heard Warren Buffett talk about the idea that he has seen, if you're going to play in the stock market, you have to be ready for your money to go down by 20, 30, 40% sometimes. And I'm going to talk about my philosophy of why I stayed in the trade in just a minute, but I stayed in it. And in this one, the buy and holders won it because at the very end, we had this big uptick. And so I ended up, this looks like I didn't take in any premium, but I think what I probably did is I bought to close my covered call. I paid money to get out of it because the rise in the stock was such that it offset my loss. So in the premium. So it makes the premium look bad the way I closed it. But nonetheless, I did 8% on this. The stock actually did 17 in this 582-day time frame. Let's move on to another. Okay.
But we do have a few responses here now.
Yeah, great.
We have one saying hold and wait, strong fundamentals and future growth.
Exactly.
And Tim is saying, I roll until I cannot get a net credit.
Right.
We have Pete, who is saying, after recovering minus 50%, I definitely would keep for a covered call. Let's see here now. And we have Clifford saying, if I had cash, I would buy additional CSP. If not, I will keep it and sell covered call for small premium to reduce my cost.
Yeah, I mean, these are all great responses, I think, to this roll out understanding if this was a leap. Yeah, there's a whole nother discussion if it's a poor man's covered call, right? But let me say this, is that what I found is that when I look at my results over time, right, that remember this trend chart that I showed you. The reason that I have this trend this way, and that's so consistent in here all of a sudden, after doing this reallocation of my portfolio, is because in these circumstances, I'm continuing to bring in money and bring in premium the whole time. Now, let me say this. We're going to talk about the capped gain versus the downside protection. So in 2022, the market was down 25% at the most. I think at end of year, it was down 22. I was like riding about 10% down the whole year. Why? Because in situations like this, where these stocks take a nosedive, I just kept selling premium until such a point as it recovered, okay? So I like to just always take you back to these kinds of ideas. Let me take you on to the next one, which was a sideways trade.
Just a quick question from here. Someone is asking, why not hedge it in the same trade?
Why not what?
Hedge it.
Why not hedge it in the same trade? Well, I indeed am. That's the thing, is while I'm my selling of premium when the stock has taken this nosedive that we see right here, that's my hedge. So maybe the stock is down 50% and maybe I'm down 35 at the bottom, right down here. And then as it recovers now, all of a sudden I'm starting to become profitable more quickly because I've got that 10 or 12% hedge. So there's the hedge, okay? Let me take on one other, is just to say that this is ARM. And ARM is one of those internet darlings, the AI darlings, but it turned out to be, during this period when I owned it, very sideways. Thoughts on ARM? While I wait on the comments, let me say this. Anytime in here where you see these drawdowns in this stock, or like right in here and then down in here, these are natural roll down and in moments, or certainly rolling in time. I have found over and over again that with that at a glance, I can go, there's an opportunity to make some money right now. And as you look over my prior trades, you're going to see that my strike prices sort of follow where the stock has traveled. And it's because I'm always making those little adjustments. I'll take as little as $10. I mean, a dollar is a dollar, right? And it all adds up. Now, in this trade, I ended up doing 12% on a stock that did nothing. Let's decompose it. 28 grand, 637 days. Brought in 5,300 in premium, 12% annualized return. Buy and hold, did 0.8%. So there wasn't much growth in this. So this turned out as a wheel winner. Now, I need to start wrapping us up because we have a few minutes left. And John, if you'd like to put that poll out there right now, that would be great. Okay, and while we wait on those answers, this trade is Meta 39.28, and during the period that I have here, I'll tell you how many days in just a minute, 535% rise, and that equated to about 155% annualized, I believe. So here's my purchase price, and now this gets to the capped upside problem, which is why I put it here, okay? All right, you ready for the reveal? You want to know what happened on this trade, everyone? Yes? You want to know? Okay, here it is. Ha! You'll have to come back next time. Just joking. Okay, here's what happened. Okay, this was $45,000 investment, 991 days. So just about a couple of years, I held it and I wheeled it. And I ended up being where you see this, where it's a super negative premium and growth. I finally got out of it, and I sold to close. I bought to close the option, and I got out of it. And then I had this much growth on it, but it netted out to a nothing bomber for me. So I lost almost 5%. The stock actually went up 60% annualized over that period of time. This is one of those that the big problem for me was cash in my account, liquidity in my account. I didn't keep enough cash in my account that I could stay ahead of this steep uprise all the while. And it actually leads me to say, we're going to run out of time here for this session, but next session, I want to dive in deeper into this idea of the capped upside part of the capped upside part of covered calls, because there is a way to be selling premium on stocks like AMD, NVIDIA, Micron, and so on. But there's a pay to play element of it, but it allows you to take advantage of a lot of the upside and then to have the hedge on the downside. So what's your initial reaction to selling covered calls at or below your purchase price? Most people say reluctant, but I would consider it. Okay if it improves my return. So my question, I'm like 2 and 3. I used to be never. All right. Now let me describe my never case. Is that let's take this as an example. Suppose that I say I'm only going to sell premium above my purchase price. So I'm up in this zone all the way across, right? Well, then in this whole area down here, I don't have any ability to make money because I've got an expiration that's up here. And if you go up into the clouds, I say, where you're way out of the money, there's no premium up in the clouds. It's all closer to the at the money line. So I finally one day said, I'm going to trade. I'm going to try roll, go below my purchase price. And guess what happened? 6 months later, a year later, I did a deep dive into the analytics on this and found that my profitability improved by 50% because I did it. But the caveat is, if you're going to do that, thou shalt have a tracker, which is why I provided you this tracker, because you need to have something like this to know exactly where you are in the trade at any point in time. Now, let me get a little bit philosophical now and give you how do I think about these trades overall. What has been my philosophical approach to dealing with this? And I look at it at 3 levels. At 100,000 feet, I'm running a business. It's a trading business. It's Gundersen Enterprises, and I'm running a trading business. I'm going to have revenues and I'm going to have costs. And I'm going to take credits on trades. I'm going to take debits on trades. I had a mindset at the beginning until my mentor said to me, hey, Paul, you need to think of your trading as a P&L. You can't always bring in revenue 100% of the time. And actually, that was a pivotal moment in my thinking because it allowed me to say, okay, I'm going to try rolling beneath my purchase price. This doesn't seem like it's a big deal on this slide, but it was a pivotal moment in my thinking about trading. Second, operationally, what is my premise? You should always be testing your premise. And I've heard you doing that in your comments today, where we had a stock that went down 30%, another one down 50%. And some of you are saying, yeah, if the premise is still good, if the fundamentals still look right, I'm going to hang on. And that's how I look at it. I review trades all the time. And then at the bottom of this, then on the ground tactically, I'm always looking at days to expiration, a measure that I call distance to strike. And I am staying out of the money because it is expensive. It gets expensive real fast to roll from an in the money option to an out of the money option because you're paying intrinsic value. I'll have more on that next time, but I want to say, we're going to close on this tracker and then give you some more homework. But in this tracker, what I did is I added in, let's just analyze trade number 1 right now, okay? So I have out of the money in terms of the moneyness. This is always recalcing. I have days to expiration, so this is to tomorrow. And then this is distance to strike. So how far do I have to go from where the current price is to hit my strike? Well, I'm 5.8% away because I'm trading at 97.3 and I have to get to 103. I monitor these 2 numbers all the time. If this gets like 1%, I'm rolling, okay? Because you want to stay out of the money. As I get closer to expiration, if on this trade it's 2 days, so I know I have to monitor it. But nonetheless, you have to be tracking these 3 metrics just all the time. And it's the same here on this Microsoft trade. Hey, I'm 1.9% away. I'm still out of the money, which is great, but that's an indicator to me, like, be watching that more closely. And when it hits a percent, roll. Okay. Now, I think we're about out of time for today. This gives us a ton to go through. Let me just put up the home. Oh, John, do you have results of poll number 2, or did you do that? I lost track.
We can show it again.
Okay. Yes. Yeah. So these are some really great thoughts. Just for those who have said never, what I want you to do is think about the idea of, if you did roll below your purchase price, that you approach it with a degree of caution, and you must have a tracker to do it. Without that, you're really kind of in trouble. So what I'm going to ask you to do for the next time is pick a stock on your CILTA list. Let's test your premises and test them at 3 different levels, right? We're going to test them strategically, and you want to be running your trading as a business. Operationally, what is your premise? Now, I will say one other thing on premise. That can extend beyond the fundamentals of the stock. Well, what are my premises going in? Well, my wife is more conservative than I am. When I trade my mother's account, I don't want to do anything that's going to really mess it up, because she needs that money for the rest of her life. So I dial that thinking into my premise about, what do I think about the stocks I pick? And I'm always testing it as I go. All right, homework number 3 is your assignment, should you choose to accept it, is pick a stock from your CILTA list. And suppose you sell a CSP, it falls 20%. You're assigned the shares, it falls again, another 10. And what do you do and why? So we'll come back on this the next time. So that concludes session number 3. And I'm excited for as many people have come. Thank you for coming. This is probably it's the only place I know of that you're going to get a deep dive, 4 sessions that goes through the entire process for beginners and intermediate traders, that helps you think about it at a deeper level. Okay, everyone, on to the wheel for today. We have covered a lot of ground in these first 3 sessions, and in the content which you'll get as slides, you see all the markers, which indicates a lot of what we'll cover in session 4. So let's just jump right into it. Today, quickly, we'll do, South America, fantastic. We'll do a review of session 3, or actually, let's just get right into the homework. I'd like to go there. And we've got these 2 trades that we put on, and they're moving around, and there's some news and I think some action to take for sure. I want to recap, do a part 2 on the what would you do session after last time, because there were 2 trades that got some particular attention. And then there's this conundrum of capped upside versus the downside hedge with the wheel. Let's talk about that. Talk a little bit about how I manage my portfolio and a life view. And then some of these other items may not get to them, but to the extent that we do, good news. And many of you have asked about this ClearSense tool that I use, how you can get access to it. So I'll cover that as well. All right, now, as for homework number 3, are you making this your own is my question. This was the assignment, and let me just play it out graphically for you. And then we'll come to the edge and start putting in the chat, if you've done your homework, what you would do. I'd like to see some of those on the screen and be able to respond to them. So the scenario is this. I don't currently own a stock. I have $10,000 in my account. Stock is trading at $100 a share. I learned about the wheel, so I decided to sell a cash secured put for $95. And I collected some premium for that. Now, no sooner did I do that the stock dropped to $80 a share after some time had passed. And so we are now, a little more time goes by, we are assigned the stock at 95. So that's our cost basis. And now we go, I'm in the wheel. I'm in the bottom of the wheel now. I own the stock. I'm going to sell it, a covered call at 85. We collect some more premium. And now the stock drops another 10%. What would you do? So please place your answers in the chat. I'd like to get a sense of what you might do in a scenario like this. Has this ever happened to anyone? It's happened to me dozens of times, dozens, literally dozens. I'll get into a stock and the next day. So we'll wait on some comments here to come back.
Well, the first is from Brett. He would roll.
I'm with you. Okay, so okay, and then now we get to the question of if we're going to roll. Well, which way? We're going to roll up, down, out, in, out, down and out, in and out, up and down, right? So we'll actually do this today with one of our live trades. What else do we have?
Well, we have another solution. I would do another cash secured put. And the same is also here.
Right. Yeah. So main point for that is if you do another CSP, you're opening up another wheel on a new position that requires another $10,000 in capital. So great. Yeah. You're saying, hey, my premise on this stock, I went through in developing my Silto list. My premise is still bullish or neutral. I'm in. So you do another one. Any other comments?
Oh, yes, there are 4 or 5 more. There is
sell another covered call.
Sell another covered call.
Now, in this situation, your current position is at 85. So I would be, someone said roll. Yeah, this is a case where you're going to roll down and maybe down and in. So we'll see. It all depends upon how far out on the calendar you placed the initial covered call. But assuming it's in the current week, then you just probably roll down and take some additional credit, right? And once again, thou must have a tracker if you're going to do this sort of thing, without a doubt. Okay.
We have 3 more.
Yep, bring them on.
Let's bring them all in. Then we have roll away. I have a contract still active. I have been rolling for 2 years. Same strike. Then we have another. I would do another CSP plus covered call. This is the gentleman that said.
Great. So everyone has conviction around this stock, which is great. And as long as your premise is the same, stay in, right? If your premise has changed for some reason, then it's time to exit, and be fairly mechanical about that. Okay. What else?
And 2 more. We have another cash secured put. And then we have another cash secured put and sell covered call.
Right. So you're doubling on the down is what you're doing here. And you're saying, hey, I could make more money when it starts to recover. Okay.
And then we have a question that I guess is a good lead into your segment. Paul, do you also roll even when it would be a debit?
And the answer to that is indeed. In session 3, I shared a story about how, in sort of framing how I deal with these at different altitudes, if you will, that once that I decided to manage my portfolio as a business, as a P&L, I moved from this idea of I'm only going to take credit to now I'll take credits and debits. And that has actually helped me. And it leads into the discussion of the capped upside of these covered calls, and especially if you have a stock that's having a major up move. Yes. And I'll show you a live trade I have today on Broadcom, where I've taken a bunch of debits because it's a wheel forever kind of stock that I'm really into, and I want to stay with them. It's also on the Nancy Pelosi stock tracker. For those of you here in the US, you would know, Google it if you haven't. Okay. Now, anything else, John, before I move on?
That's all.
Okay. So let me move us into then, we've had this tracker that we've been following of 2 stocks, ServiceNow and Microsoft. And I did a little time lapse on this yesterday just to take snapshots of this across time. And the most important aspect of it, I would say, is that essentially at some point, look at the swing in the second stock on the bottom from 924 down to 1322. At some point, it went even further down, 1800. So these stocks are moving around, and that's one point. And then the other thing is, notice in the ServiceNow stock that I'm down $309 in this, but we've collected $125 in this, roughly in this stock already through premium in these two black transactions right here. So there's the beginning of the hedge, right? That is the stock, if the stock declines, I can hedge it. And the other thing I'd call attention to, and let's bring up the live tracker now so you can see that. This is right now, as of this minute, where we are in service now, okay? So it's gone down more, and now we're down 13% in the stock versus where we sold our covered call. Meaning we got into the stock at $90, and essentially, oh, that's the price right now, and essentially we got in at 98, so it's down 8 points. And then we're currently in a covered call at 103, and there's a 13% gap between the current share price and this 103. So that right there is the clear indicator of like, it's time to roll down and or to roll. So let's start to think about what that might actually look like. Okay, so this is what I would do. I'd do one of two things. Let's do it in the current. If I'm in Think or Swim, what does it look like? So this is my current trading platform, and I'm going to open up this this expiration, the June 26th, and you'll see down here is this little marker. It's hard to see, but this is where we are right now. And so if I were to roll up to 20 delta right here, because I'm at 2 delta, right? Oh wait, delta. I'm at 1 delta right now. If we rolled up here, we'd probably get about 40 cents, 35 to 40 cents between this, this mark. I'm jumping around a little bit here, but between this 2 cents to buy it out, I've got to buy to close the current position and then roll up and get 37 cents. So I'm going to get about $35 in this trade. So that's one way to do it. And then I brought up this tool that I use quite a lot, this tool I call ClearSense. And this has helped me to, let's just let it load the option chain, but this has helped me to make decisions like this as well. So I'm on the 103 strike right now. And if I put a marker there, what I can do is I can click around and I can see how much money I can make up here. I mean, it's kind of hard to, it's small for you, but nonetheless, I like, if I turn on my deltas, this is 25 or something, I don't mind rolling down to 94 or even rolling out a little bit in time, just because I can make money in just about any direction. I can roll out, I can roll down. If I wanted to go out to the 17th of July, I'd bring in $300 right now to move from here to here. So I think what I'm going to do, the 26th is tomorrow, and let's just roll down to the 94. Okay, so we're going to go from the 103, we're going to do a roll to 94. And, I don't know that I've done this in a while. So how do I do it in here? That's kind of interesting. I don't mean to get stuck. Monitor. Trade.
There is a question here that's just relating to what if you always roll to 20 delta.
Well, that's a good one. Yeah, do I always roll to 20 delta? Not always. I like that as a starting point for sure, and then I really vary quite a lot in terms of what I do. I try to stay about 5% away from the at the money line at all times. So, and most of the time that equates to about 20 delta. Okay, so we're going to go to the 94 strike right here. And I'm going to buy out the 103, and I'm going to sell to open the 94. So I can just go to that, right? We're going to make this a day order. I'm going to do it as a market. So it just goes and trades right now, and we're good to go. Okay. All right. So we got some money for that. You can hear the trade just went through. And let's go look at that trade. All right, so here it is. I got $1.50 credit on it. So let's take care of now the management of this trade right here within the tracker. Okay, nothing is more important than doing this. So what we did here is we rolled this to close out this position, and now we just copy this and we went to the June 26th. What did we do? The 94. Okay. And we did an STO because the roll, this is the buy to close component of it. And then this entry date is today, 6/25, and we got $1.50. All right, so that's kind of cool. We've collected $293 in rent. Okay, that's kind of neat. And then over here in the current statistics, now we've given ourselves back $150. So we're down a little bit, and we're 3.8% off the line. And the way I do my calculus on DTE, this tells me I'm close because tomorrow is the expiration date. So I like to do my rolls on Thursday, which is why that shows up as a 0. Okay, so now we're done with the ServiceNow trade. And now let's move on and get a look at our Microsoft trade where we are in the bottom of the wheel. Now, what happened yesterday is that we had this covered call, the June 24th 380, which expired on Wednesday. It expired yesterday. So now let's just do the next. What do we do next? We're going to add a covered call around 20 delta, and let's go get a look at Microsoft in here and see what our choices are. In fact, I'm going to do it. I'm going to bring this back up, go into another account here. Trade, and somewhere down in here I have Microsoft. Okay, here we go. Oh, and there's nothing on it. That's right. I have these 3 positions that we bought into. There's nothing on Microsoft at all right now. So all I have to do is go to Microsoft and sell another covered call because the last one expired out of the money. All right, so here we are. And 20 delta is sitting here at about 360, and I can get about $1.29 for it. So we're going to sell a covered call, close this down, and then bring this back so we don't do 10 of these. Change this to a market order just so it goes through quickly. And here we go. All right, let's see how that worked out for us now. Okay. Filled orders 1. All right, we got $1.32 for this. And this is the June 26, 360, $1.32. All right. Here we go. This is 626, 360. We had $1.32 STO. This one up here is the one we had. This one expired, so we'll get rid of that. And then we just carry this information down. Okay. All right. Now, once again, already in just a couple of days, since we started trading this position during the course, we brought in $326 in rent, in premiums. And we still got a ways to go to catch up, and Microsoft has to recover. But essentially, that's where we are in these trades right now. Questions on these 2 trades before I move us on to the next part of our...
We have a number of questions, actually. So I will just bring them in one by one. And I think 2 of them are more or less the same question or variations. We have this question on the covered call at 85. Assumed it is below cost base. What if stock rises quickly? Well, they're not the same. So
okay.
Take this one first.
Yeah, if this one, so you have a covered call at 85, stock rises quickly. This is where I would say if your premise is the same, that I'm bullish on the stock, I believe in the stock, then roll up or roll up and out in time so that you can either, you'll take a debit if you roll directly up and you'll take and you may get a credit if you can roll it out in time. It depends upon how quickly and how much the rise was. Is it a gap up of 10%, 20%? That's going to be costly, and you may end up rolling out. If it is a gap up that's 2 or 3%, roll up, take the debit, and then keep rolling from that point forward.
And then we have another question also from the same participant. Do you use any metric like delta to determine when to roll down or up, or do you consider DTE?
I almost exclusively am using these two. I do follow delta, and delta and my DTS metric, my distance to strike metric. They're, if it's 20 delta, that's probably going to be 5% difference most of the time. So I'm looking at this DTS all the time. And as that gets close to 1%, to me, that's when I roll. So you can look at deltas and you have to say, well, what's my tolerance? Like a 20 delta says, hey, I'm leaving a fair amount of distance between my strike price and the current price. So I don't mind deltas coming into the 20s and into the 30s, coming into the 10s and to the 5s. That's fine for me. I'll monitor that. But I definitely use DTE and distance to strike, DTS, as my main metrics that I follow all the time.
And then Valdemar, I guess it is. It's hard to know the names out of this YouTube username, but this must be Valdemar.
Valdemar Ramos. Right.
Are you rolling down below your break even?
I will. It's unusual for me to be rolling. I need more of a scenario actually to be able to answer that question. So if you want to put a follow-up in the chat that we can come back to, that would be great.
All right. And we have one from Chris. During rolling, do you like to follow a certain DTE?
Great question. Now, as far as following certain DTEs, what I'm always looking for is when we go to choose an option chain, right? I was showing this to you the other day. When I was showing you when we were looking across TOS, do these stocks have sort of broad and deep option chains? I like weeklies. I like to stay close in time with certainly. So when I look at, I'll just pick, all these option chains I'm picking right now, they are deep and wide, right? But, you start coming across option chains that don't have as much breadth or depth, then, you got to watch out for those because especially those that because they become less tradable as time goes on. These are all pretty decent, these option chains, but look for weeklies because then you can keep your trades as close in time as is humanly possible. And I'll just make one other point here. Think of your rolling as a server at a restaurant who has more tables, right? The more tables they have, the more time they can turn those tables, the more money they're going to make. And that is certainly going to be true in wheeling, that if you can keep your trades, let's imagine you're a week out, you get 52 tries on that trade. If you can keep it at a week out, if it's a month out, you get 12 tries throughout the year. So you're not turning your inventory as much. So I like to follow the weeklies and stay within 30 days is as much as is humanly possible. Not always possible, but I do it as much as I can.
Then we have a couple of questions about ServiceNow. So you might want to bring that back because that's more of a clarification, I guess. It's Franz from Switzerland who's asking, isn't expiration in July?
Meaning the one I just traded?
I guess so. I don't know.
Let me go look. Quickly monitor that ServiceNow trade. Got to get over here. Oh, you know what? Yes, I moved it to the 2nd of July, kind of by accident, and that's why I got more premium. So it is the 2nd of July. So, oops, that's what happens in live trading.
And then we have in the same group, Tim, I think your cost basis for now is 95.07.
That is probably the cost basis of the stock for us, of the stock is 98 in ServiceNow. And the reason for that is that we sold a cash secured put at the beginning of this road which was at 98, and now If we include the rent that we have taken, then we're taking away $2.93. So yes, you are correct. The cost basis for ServiceNow is now $95.07. So let me unpack that again, just so everyone sees how this goes. So we got into ServiceNow at $98 and change, okay? And then we've sold premium in the amount of $293. So that's I have to divide it by 100, so it's on a per share basis. So if I just do this and divide by 100, there's your 293. 98 minus 293 is 95.07. So that's how Tim Ritter has now come up with our adjusted cost basis, because that's how it works with these options. Is you can roll and roll and roll until your cost basis is below zero. That's kind of interesting. All right. Anything else?
Yeah, well, also one comment or question about the Microsoft trade. Will you sell Microsoft because it is too bearish? And if so, when?
Microsoft, my premise, this is at the heart of this question is, when do you get out? And so my premise on Microsoft as being a planetary hyperscaler, part of this AI revolution, is that over the next 20 years, certainly over the next 5, we're going to see them, go up and continue to go up, and maybe they double or triple the size of the company due to the AI related work. So I'm bullish, and even if it dropped as much as 50%, I would stick with it, because I think in the long run it's going to recover. And I showed some trades in session 3, I think, that had gone down 30 to 50%. I stuck with them, just kept rolling.
And another question from Chris. Do you have a portfolio with using constantly the same stocks? Anyhow, and how many stock do you do at the same time? I guess it is.
Okay. Well, I have a fairly diversified portfolio. I tend to gravitate right now to a lot of the biggest names in tech that you would be hearing of. I typically, as far as how many stocks I hold at the same time, that's just something I can't disclose. I'd love to, but I can't. Thank you.
And the last question here from Clifford. What do you see before you decide to roll?
What do I see? I think, Mr. Clifford, that on that one, what I'm always looking at without fail is DTE and DTS. And as calculated right here. And I may be looking at Delta, but my tracker has all of my stocks listed, and I can see every single one, and I know right where they are. So I will say this, if it goes in the money, like let's say it goes 1% or 2% in the money, I will roll out like that and get out of don't wait. Because be mechanical about that, because you don't know if it's going to go really deep in the money. And I'm going to come to that in just a second in the next trade and in the next segment of this discussion. In fact, let me use that as a segue to take us to the next piece of this. Any other questions, John, before we...
No other questions. Tim is telling us he's also getting murdered by Microsoft, and sending us a heart. Thank you very much for that.
Yeah. Well, the beauty of the wheel is it works in both directions for you. As in, you may say, well, my upside is capped, but you definitely have a downside hedge in the wheel. And I'm going to talk about that in just a second. So hang with me. In fact, let me talk about that right now. I think this is a good time since people are asking that question. So 1 second. I just got to get to the right slide. All right, so this is interesting. This is the S&P 500 since 2022 to present, okay? And so you see by year, you see the percentages of how the S&P has moved. So down 20%, 2022, up 24, up 25, up 23. We're up about 10 this year so far, maybe 8. And so that's 80% growth inside of a 3.5 years. And we had this down move. people say about the wheel that it has a capped upside. What I want to point out is that in all inside of this big up move, we have had, a couple of corrections along the way. I mean, an 18% drawdown in 2025, and then it ratcheted back. And what I like about the wheel is that it is a downside. It gives you downside hedge protection. I get banged around by people when I talk on these topics because someone like last year, I did 20%, maybe 18, 20, right in that zone. Well, the S&P beat me. So some critic is going to say, well, you missed it. You missed the upside of that. And then I say, well, but let's dial back to 2022. In 2022, market was down 20%, and I was down 8%. And that's because I'm always collecting premium, and it offsets the loss. That's this the slope to something like this later on. So you have to keep, and that's true at an S&P level, and it's true in the microcosm of a stock as well. That inside of every major up move, you have a lot of major down, little tiny down moves. Each one of these down moves is an opportunity to roll in and down and make premium. And now you got to watch out because now it's going to come back, right? But what happens next, we never know. And so I'm just always in the process of selling premium. And on Microsoft right now, and on a couple of these stocks, I've had this very challenge where the stock price has gone down, but I've just continued to wheel it, if you will. So be really aware of this because it's a two-edged sword. You have the potential capped upside as we see here, that you can have caps when you see very steep rises like this, and then you can also win on the downside as well. So, and I like this aspect of it, that my wife likes it a lot too. And you have to dial this whole thinking into your premise, meaning the premise is not just the stock. It is what is your risk tolerance. My wife is very conservative. So for me to be wheeling is like off the charts for her. She didn't like it at first at all. And then she finally got used to the language of it and my talking about it and my socializing it with her over a long period of time. So just be aware of that in your premises. Now, let me take us to two trades that we started talking about the last time that I think are important in the what you would do. Now, you will remember that I talked about this meta trade and I want to make clear to everyone that this was a bad trade. I didn't follow my rules well at all. I was on hopium thinking, well, I'm selling premium down here. I did a bunch of rolling down and I made money on the way down, and then it started going up. So I started rolling up and out, and then I finally hit the wall. I couldn't go out any further. Dumb. And it gets expensive. If my expiration is far out in time, you all know it gets very expensive now to roll. I need a couple $1,000, $10,000, $20,000. And all the while, Meta kept on going. I then said, well, I'm just going to roll sideways until there are no more expirations. I'm going to keep collecting premium. And then finally the day came where the stock had gone up so far that I couldn't collect any more premium. And it got called away. It was a boneheaded decision. So I want to say that about that trade, give you some information about it. But that's one. And then the other one I'm in the middle of right now, this is a live trade, is Broadcom. And I want to talk about rolling up for a debit, okay? So in this, now Broadcom has come up quite a lot. I made a fair amount of money here on the side, just going sideways, and then went up 30%. So in this case, I'm trying to find my spreadsheet here so I can show you the metrics on this. Just a minute. All right, so here's my Broadcom trade. This graph here shows my purchase price. It shows in green in blue is the stock price, in green is all of my rolls right here. So up here on top, you see I'm making, now this is the cumulative of all my premium collected. So I'm making money, making money, making money. Oh, look at this. Stock price is moving up. I gave back some money here. I gave back some more here. Went sideways for a while. That's good. That's really good for the wheel. I made money there. And you'll see the debits in these transactions. So what happens is if we really dive into that, I'm at the 340, I'm rolling up to the 345. I had to pay $252 for that. I'm at the 340 again. I had to roll up to the 350. I paid $400 for that, right? Same thing again. So definitely rolling up is fine. And in this case, just look at the scorecard here now. This is as of this morning. I'm up 29% raw percentage, and Broadcom is at 16.5. So because I'm doing all this rolling, I'm actually making out pretty well. And in periods of sideways movement, especially, or little down moves like you see here towards the end, you can actually do pretty well. And so I'm actually beating a stock that had a big up move of, this was 30% across here that you saw in the slide deck. So just be aware, you know, if you're agile in your ability to roll, then I think you'll do well in this process. But tracker, you must have a tracker. You must know where you are in your positions at all times. Okay. Now, questions on this. This is all good stuff, and I wanted to review this again.
Let's see. There are a number of there are several comments around Microsoft, and well, there is one question here from Brett. How do you feel about a possible strategy to mitigate a downward trend, selling covered calls near at the money each cycle?
I like that strategy, actually. I like selling covered calls at the money, but that to me is a different strategy. All right, it's what I have a strategy I actually trade that I call the at the money strategy. Where I'm trying to take, if there's an earnings play and I think the stock's going to rise, is one scenario. That's not this scenario, but one scenario is I sell an at the money call, hoping that I buy the stock, sell the call. I hope it gets assigned right away with an up move. And typically I can make healthy premiums on those moves. Now, to mitigate a downward trend, selling at the money, that can work, but so imagine that the at the money line is at 100, and you sell this covered call, you pick up $100 in premium at 100. Stocks goes down. Well, let's say just like our ServiceNow stock, it goes down to 90. Opportunity to roll that 100 down to 95 and pick up some additional premium. Now you've just gone below your purchase price, so beware. But nonetheless, I like those opportunities. I take advantage of those. It's a good strategy. It can work. My at the money strategy has been fairly profitable for me.
Okay, I think we will get to a couple of other questions here. There is a question about was the wheel back tested ever? If yes, what was the result?
I couldn't tell you, meaning I haven't back tested it. I've just read up on the literature a lot that says and particularly in some of the Facebook groups, there are some good folders in those groups of people who've run the wheel for a long period of time. And they've said, if you trade it this way, you should be able to make 12 to 15% on the wheel plus whatever you collect on dividends, and get some upside if you're lucky. I'm sure there's some great scholarly papers on wheel back tests, but I have not researched those.
One question here from Valdemar, follow-up question on rolling below break-even. It is related to your first position now. You were signed at 98 and rolled a covered call to 94.
Yeah, I did. Indeed, I did. And yes, that is exactly, this is the ServiceNow trade. So we came in, we were signed at 98, which is right here, our first transaction. And then we sold 2 covered calls because the price has moved against us. So we're down at 90 now. This is the last price of the stock. And we have in force a contract expiring tomorrow that is at 94. So they'll probably expire out of the money tomorrow, is my guess. And then I'll just sell another covered call on Monday.
And there is another question from Chris. To compare your trading with the classic wheel strategy is that you constantly roll. When do you decide to stop rolling?
Right. Classic wheel strategy. This is it's an interesting question. What actually is the classic wheel strategy? Well, in my view, the classic wheel strategy is I sell a CSP and then I get the stock slightly below, it gets assigned to me. So well, let's imagine price is 100, I sell a CSP at 98 and I'm assigned. So now imagine I sell, I have the stock at 98. Imagine I sell a covered call at 102, okay? If in the classic wheel, if the stock went to 104 the next week and got called away, you'd be out, okay? There are some people who say, well, if the stock goes down and now you're taking and moving from an unrealized loss to a realized loss, you just simply, you collect the premium in both cases and you move on. So I prefer to make money on everything I do. And so the classic wheel strategy would be to just, do the 98, 102 that I just described and let it get called away. But I'm always looking at, well, where did I get assigned at 98? And I want to make some upside or at least break even if I can. So that's how I perceive the classic wheel strategy. And then when do I stop rolling? Well, it really comes down to if my premise changes on the stock and I'm not interested in it anymore, or it just got, if it's going out of business and I need to exit, or if I'm doing something dumb like my Facebook trade, my meta trade, then get out, right? But otherwise, I pick stocks that I think have good upside potential. They're long-term compounders. That's how I've made my decisions to do these things.
And there is a discussion around Microsoft and Ivy and Ivy rank, and I'm not going to show all the messages here, but essentially maybe you could clarify the difference between Ivy and Ivy rank.
I'd like to take that as a separate question, only outside of this, only because I have other things that we need to get to in before the end of the hour. So if you don't mind.
Then I think we are through with all questions.
Okay, sorry, but I'll pick that up at another point in time. All right, let me just zoom out a little bit now. And there are a couple things we need to cover off before we wrap up for today. And I want to go back to the idea of something that we're all very familiar with, but as a reminder to people of all ages who are attending this session, and that is the idea of compounding. We all know it, but I want to encourage those of you who are at the younger end of the spectrum to start investing consistently in your life, because I started at 24. I'm now 62, and I was able to retire on my magic birthday of 59 and a half, largely because I started young. What I want to point out here is this slide in the red box is the $1 million proposition. It's the person who puts $100 a month in for 45 years, and they just keep doing it. And you look at how long it takes for this graph, for the graph to start really pointing upwards. It takes a while, and then finally it starts going up quite a lot. And the reason I put this up here is just to say that I work with a lot of people, and a lot of people are kind of hurting when they get out to the 60s, when they want to start slowing down or doing something different. This is the profile of the person who waits just 10 years. So that $1 million goes down by 60%. So again, to those of you in the room, invest, invest, invest. I can only encourage you to take the first, think of your income this way, that you're paid for 8 hours a day if you work for someone. Take the first hour of every day and take it out of your paycheck and invest it, all right, forever. And if you're not able to do that because you go, wow, that's a lot of money for me right now. I want to say, if your employer came to you and said, we're having a hard time as a business, we need to cut back everyone's pay by 12.5%, right? Most people would go, ugh, and they'd rip the Band-Aid off. They'd think, well, I'd have to go find another job, which I really don't want to do right now. And so first month, they'd be like, wow, that's hard. 15% or 12% of my pay is gone. Next month, month 2, it would hurt less. And by month 3, they don't even notice it anymore. So it's the same thing with investing, like rip the Band-Aid off. If you're not doing this, do it. I can only advise you and say, and part of why I do this is to encourage people to invest. And the person who waits till 40 has an 85% drop in their number versus the person who started at 20. Right. Now, the other thing I wanted to touch on outside of this is that's kind of my life lesson for the day is please, and encouragement, please get started on this. I'm 62 now, and these are not my numbers, but I want you to think about, for those of you who are nearing retirement, like, how do you decide how to do portfolio allocation? And maybe you have a financial advisor, maybe you don't. But suppose this person has $3,000 in non-investment income. Them, their spouse, on Social Security, they get some money. They have expenses of $4,500. They have a gap of 15. So now they have to go find out, they have to have another source of income, which is their investments if they've done it. So they need 1,500. So the way I did it, and this is a pie chart that gives you a feeling of my portfolio, is that I call this gap income, this big orange area right here. And what I did is I just back calculated, and with my own numbers, not these ones, but I said, well, I need X, and I like these 2 funds called JEPI and JEPQ. They put off 8 to 10% dividends per year, respectively. And so, I kind of back calculated and said, how much do I need to allocate in order to generate $1,500 per month? So that now that that's taken care of, the rest of my trading, I've allocated a bunch of money to AI super cycle stocks. I don't really wheel these. I purchased some value stocks that are great long-term compounders, but they've fallen out of favor right now. And I think in Warren Buffett would look at them and he'd say, those are great value stocks. I'd buy them, And then I have a portion that I wheel. Now, hopefully what happens is that I make out well enough across this whole pie chart that at the end of the year, it's bigger. And then I redo the numbers next year. Okay, what's the income? What's my expenses? What's my gap? How do I need to allocate this orange section? This is how I think about it. And for people who are nearing retirement, your financial advisor probably won't go through an exercise with you like this, but it's very simple. It has worked out very, very well for me. Now, let me just move on from that. I think this is a little commercial thing for people to know about. You didn't ask for it, but you got it because I help people with their finances all the time, as well as doing my own trades. And then I just want to touch on a number of things, some big picture things. What questions did we address in this seminar? We addressed a lot of different questions. We started out with like the basics of the value prop of the wheel, where we said, remember, you get 1.2% dividend on the S&P, Dow, and NASDAQ, 515 companies. Wow, that means I need $1 million to generate 12,000. Why the wheel? What if you could generate that same 12,000 on 100,000 in portfolio value? Or if you only have like 10,000 and you want to get an extra $100 a month, that could be very helpful to you. So we talked through a lot of these ideas, talked through making money, the 3 ways of making money: what? Growth, income, and rent. We had the comparison of the wheel to real estate. I want to say your number. Everyone has their number. What's your number? And the reason I ask this is to say, like, you might go to a financial advisor and he might say, well, you need to have a portfolio of this big to be able to fund your life at some point. And you might say, well, I don't have this, I have this. And then, so how do you bridge the gap? Well, the wheel can be a way to do it. So we've covered off a lot of those things. How does the wheel perform when the market drops 20%? I roll down and in a lot. I collect premium. It's a hedge for you. We talked about a lot of terminology and concepts around the SILTO list. What is a cash secured put, covered call? And really, for anyone new to try to learn this terminology and the mechanics of it, we got into that in sessions 1 and 2. A bunch of objections people have around, hey, this is complicated, it's risky, there's a time commitment, my upside is capped, my downside, what about that? There's a hedge there. And I just want to say to these standard, they're common objections that I hear to this is if time commitment. Most people spend more time watching TV and scrolling through their phones than they do thinking about their finances. Think about it. Invest the time. Risk. Well, we've gone through a bunch of different risk ideas. I think it's of all the strategies that the wheel is the only option strategy that improves your return and it decreases your risk. There's a guy named Dan Paolini who was with the CBOE, had a discussion in Las Vegas that really gets to this idea. So just some things to be thinking about. We covered all these questions around trade execution and some gotchas, and it's been a lot of work to get through it, but definitely well worth it, I think. And then people often ask me, well, like, what do I, here's some more questions that we addressed. Well, but what websites do I use? Reading and learning, what do I like? We got into option chain tiers and the whole bid to ask ratio, which are more advanced concepts, but they're very important to trading and tradability. And then finally, reading, learning, and the web. Well, where do I go? My favorite sites every day, I'm on Earnings Hub, Fast Graphs, and TC2000. TC2000 is a chart package. And then I do a lot of my research on these other sites as well. And then definitely I've read The Intelligent Investor by Benjamin Graham, The Options Manual by Gastineau. I'm always watching YouTube videos on stocks, learning from none other than Theta Profits for sure, Trade Diff, and Facebook. So there's a podcast I really love called The Meb Faber Show. So these are some of the things that I am reading and learning from all the time. And then I'll just say two more items to cover off. One is some credits, and I give them to Dale Perryman, 40-year longtime friend of mine who taught me. He was my mentor. So much of what you're hearing me say, he has said to me, and he's an expert options trader by far. John has been tremendous in opening up Theta Profits to be able to present this to you. And then Meb Faber has influenced me quite a lot from the Meb Faber Show. I actually was able to meet with him in Manhattan Beach, California a while back. It's very, very interesting. So now the last thing I wanted to cover off, and then I'll take any final questions, is some of you have asked the question about this ClearSense. And so we are proud today to announce announce ClearSense to you. What is it and where are we going with it? Okay, it is a tool that allows you to see where the liquidity lives, and so it's for wheel traders, but really I can broaden that to people who are in the covered call CSP business, where they're looking for liquid stocks, attractive premiums, and better trading opportunities. And you all know now SILTO, liquidity, CSPs, and rolling by coming through this course. And the question for me was always, well, how do I find opportunities quickly across hundreds of stocks? And this has been helpful. So if you want to collect red, the challenge is not finding the opportunities, it's finding the tradable ones. Big difference. Not all premiums created equal. And if you want the ability to more easily enter, exit, roll your position, then this is a tool that could help you. Liquidity, we've shown you some examples of that. And it has three basic areas right now. We'll be expanding this quite a lot. One is, I call it where's the rent report, right? Where are the best rents in the market right now? And so this report gives you stack rank from top to bottom, the best premiums for the price of the stock across the Dow, S&P, and NASDAQ stocks for this coming Friday's expiration. So it gets run every day. Second is where should you look first? Which stocks are most tradable? We'll be putting out a version of this report that is broken down by liquidity tier as well as price range, because all of these that are shown here have very high prices, most of them, that would require you to invest between $40,000 and $100,000, and many people are just not there. So we've created a price range view of this as well. And then, of course, the liquidity inside, what are the most tradable strikes and expirations for a stock. So this has been very helpful to me. And when we developed this report for the first time, I made money on the first trade, because right away I could see, oh, it's liquid over here, it's not over there, go over there, and I traded and got my money. So it's a companion tool that helps people identify liquid stocks, option chains very quickly, visualize where the liquidity is, and accelerate your SILTO research. So we're offering this as a 2-week free trial, no commitment required. Many of you, I think we have about 25 people from this group already snatched the URL and basically signed up. And then it'll be $30 a month thereafter for the trial. So that's the commercial. And I guess I should add one more thing to this, because everyone wants to know where to go. So you can go out to app.coolera.net. Just screenshot that if you're wondering, but app.coolera.net, and there is a registration for it. So all that said, everyone, I thank you for your interest in and listening over all of this time period. We've had 4 hours together. I've worked to pull together a course that would help the beginner to sort of orient themselves to where they are, meaning wheel terminology, that whole thing about the austereogram photos that we all do this to, and then all of a sudden it comes into focus. I'm hoping that this course becomes that for people, that if they're starting out, they go, you got to watch the course on theta profits, because it really helped me get started. So all that said, thank you, everyone. We're right at the top of the hour right now, and I appreciate you listening in over these 4 sessions.
And I would like to say thank you to you, Paul, for bringing us through 4 sessions in such a great way, and with all your knowledge and your teaching skills. So I think it was has been amazing. So thank you to
yeah, thank you everyone for coming.